A government shutdown averted temporarily. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to closing bell here in the U.S. Not seeing too much of a bid materialize, at least when it comes to the S&P 500. Your big benchmark down about 0.4% on this first trading day of October. You're seeing slightly more action to the upside when it comes to big tech. The Nasdaq 100 up by about 0.3%, all while that bond sell-off continues. You take a look at 10-year treasuries right now, up about 10 basis points. We are nearing 4.7% on that 10-year treasury yield. We'll see if we get there. And I want to take a look at the dollar too, Romaine, because we talk about where the haven is. Looks like we're seeing a little bit of a haven bid into the U.S. dollar currently. The Bloomberg Dollar Spot Index up about 0.6%. Yeah, a lot moving today. And of course, we know financial markets really were bracing for a shutdown to start the week, Katie. We know that. They got a bit of a reprieve, just 45 days here, as lawmakers over the weekend did patch together a short-term solution to fund the government. Now, that buys them more time to strike a more permanent budget deal. That short-term compromise, though, it gave equities only a brief respite. We did open higher, but the focus in markets quickly shifted back to interest rates, which resumed their climb higher here to start what would be a fifth straight week of escalation. Leveraged fund short positions on longer-dated treasuries still near record levels, and the dollar now pushing back up to year-to-date highs. Gold falling back down to retest the key technical level of support here and letting you know once again here that this is still a macro-driven market. Meanwhile, oil flipping from gains to losses on the day. Mixed signals out there around the restart here of new supply, fresh supply. A key oil pipeline connecting Iraq to Turkey could potentially help ease some of the supply tightness. That seemingly persistent tightness, of course, has prompted a lot of calls for a return to $100 a barrel for oil, whether it's on Brent crude or WTI. Ministers and oil industry chiefs right now gathering in Abu Dhabi for the biggest energy conference in the Middle East, where the prices can hold at these 90-plus levels, and the outlook for OPEC plus supply cuts. Those are among the hot topics of discussion out there right now. But our next guest, Katie, sees the global crude market potentially swinging back to a surplus next year, which would actually push prices back down, maybe potentially down into the 70s. And you take a look at where that actually looks on the chart. Of course, we're talking about Ed Morse's call saying that maybe we'll get to the low 70s in 2024. That wouldn't be that unusual. If you look over the past year, we, of course, were hanging above 70, close to it, through most of the spring and the early summer. Of course, if you go back a little bit more, we've trended towards there. But, of course, over the past couple months, we've been steadily heading higher, above $100 a barrel on Brent. We got there. Now around 90. We'll talk about what it'll take to get back to the 70s. And if we did get back to the 70s, maybe it would help that soft landing narrative. There was a really interesting analysis out from Bloomberg Economics saying that a soft landing still isn't the likely scenario. And if you take a look at media articles that mention a soft landing, you can see that those bars here, they tend to spike before recessions. They did in the early 2000s. They did around 2010. Of course, the pandemic was a bit strange, but you think about past spikes, you take a look at where we are in 2023. It's going to be really interested to see if that shaded recession bar follows this current episode, Romaine.
All right, let's get some insights out of our first guest here. Ed Morse joining us right now to kick us off to the close. Citi Global Head of Commodity Research. And Ed, I do want to start off here with the recent increase in prices that we've been seeing in the crude market that I think conventional wisdom says is primarily a supply side story here. Is what we're seeing with regards to supply, or rather the lack thereof, is that giving us an accurate picture of what's out there?
Well, actually, the supply side was the basis of it. We certainly had cuts that led to, decline in inventories, and the decline in inventories looks like they were about 1.5 million barrels a day, maybe even a little larger than that. But financial flows really helped a lot. So in addition to what we saw on the supply side, we saw the long-short relationship among managed money participants really skyrocketing. It started the third quarter at a ratio of about 2.6 to 1. It reached a peak of about 13.6 to 1. Last Friday, it closed at 10 to 1. We're seeing levels of flows into the length. Those are mostly CTAs, but also some speculators. Also some people playing the closing of the dated Brent market, which requires now American crude going into Europe. So we've seen unusual things happening on the financial flow side as well.
I am curious, given where prices have been, and we talk about the end products, refining to be specific here, how much do the refiners end up playing a bigger role in where prices go next?
Well, refiners have been playing a role, so to speak. I mean, it's not that they've intentionally done it, but we've run a little bit out of refining capacity. The OPEC cuts took the wrong kind of crude out of the market, so the crude was much less distillate rich than it might have been. So the distillate market really tightened up significantly. We saw that in the relationship between light sweet crudes and sour heavier crudes, which normally are sold at a discount to the light sweet crudes, but we had them at parity for a lot of the third quarter. And it was only as we got into September and we saw more of the heavier crudes coming back into the market, fewer lighter crudes, that we saw distillate-rich crudes coming back. And now the spread between them is widening again, back to normal, basically.
And let's go back to Brent and your call for Brent to go back to the 70s in 2024. That obviously would be a supply story. But when you think about that forecast, how big of a risk are you considering that maybe demand will come in stronger than expected?
Well, we don't think demand is going to come in stronger than expected unless for some reason there's a change in every economist's judgment about where economic growth is going to be next year. But the drag from China, the drag from Europe, and what we expect is a drag from the United States coming into the market really weighs heavily. So if we have 1.4 to 1.7% GDP growth in the world, it's hard to find a number on the physical oil side that can't be readily met without having a surplus in the market.
And looking through your note, you write that higher prices in the near term could make for more downside for prices next year. Could you walk me through that relationship? Higher prices right now, what is the lag between how that translates into future demand?
Well, there are several things at work. One of the issues is really China and its role in the international oil system. It's got a role that's almost as important as OPEC Plus. So, and they've been playing this role since the great financial crisis, when they discovered the benefits of buying oil when the price was low and selling mostly product when the price was high. And that's exactly the position they are now in. They accumulated between just before the pandemic and now about 500 billion barrels worth of oil. We estimate that their inventory of crude and product is about 1.4 billion, equal to about 130 days of forward demand cover. The IEA typical country has a rule of 90 days of forward cover. That's pretty conservative. So they've really overdone it. Maybe there's geopolitics in it as well. And now they're selling more product. So they're going to be weighing less heavily with a high price by buying less high-priced crude. And they're going to be taking advantage of what we're seeing in the distillate market and to some degree the gasoline market with these high margins in the refining system by selling more of that into the market than they otherwise would.
For those folks who look at the commodity market as sort of a read on economic conditions, we've seen what energy prices have done of late. We've also seen industrial metals not do much of anything for a good portion of the year. I don't know if that's largely the China effect or not, but what is that telling us about the state of the global economy right now?
Well, the metals demand has been off, and it's not just China that's not been as high as people expected, partly because the Chinese have actually put a lid on how much metals they're going to be manufacturing here and there, whether it's got to do with economic security, or whether it has to do with going green, or a combination of the two. It doesn't really matter. They do have a lid on what they'll process in terms of aluminum and in terms of steel. So that does matter. But the rest of the world has not seen much in the way of demand. PMIs have been in negative territory, and we expect European manufacturing to be low and U.S. manufacturing to remain lower than what it might be with a growing economy.
Yeah, we got some new data this morning.
But we are bullish, definitely.
Right, but coming back up, right?
We're bullish eventually, like by the end of...
Eventually? What does that mean, like next year or 10
like
years
next
from
year,
now?
yeah.
Yeah, really?
Yeah,
Okay.
we think that...
Yeah.
The demand for copper is going to go up. The supply is not going up. That's basically an industrial metal story, but copper is pretty extreme on it.
And is there any other big player that we should pay attention to other than China and obviously the U.S. for that matter?
Well, of course there are.
Yeah.
We talk about the Fragile Five a lot. These are 5 countries that have been members of OPEC: Iran, Iraq, Libya, Nigeria, and Venezuela. They've all kind of been very disappointing in their production. People have ignored them. But actually, year on year, their production's up over 1 million barrels a day. And we think year on year, it's going to be up another 1 million barrels a day. And we think the OPEC Secretariat and the IEA have not really taken into account this new change in production activities in every one of those 5 countries. Maybe Libya is a little bit of an exception, but it's certainly reopened to foreign investment. So it should be growing.
All right, Ed, great conversation. Great to have you here in studio. Ed Morse to help us kick off to the close. Citi Global's head of commodity research. Coming up, we're going to hear from our exclusive interview with the CEO of JP Morgan, Jamie Dimon, giving his thoughts on the financial sector, the economy, and the impact of AI.
Plus, a prolonged UAW strike could have far-reaching impacts on jobs and on the economy. Bloomberg Economics has crunched the numbers, and we'll bring you their in-depth analysis.
And a court rules companies like Uber, DoorDash, and Grubhub, they must pay their couriers $18 an hour here in New York City. The company's calling it extreme. We're going to take a closer look here at that controversy. All that and more coming up in just a bit. This is Bloomberg.
JP Morgan hosting its Techstars Leadership Forum in London, and Bloomberg's Emily Chang sat down for an exclusive conversation with JP Morgan CEO Jamie Dimon, where she asked him about the impact of AI on the financial sector.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation. It's large language models. It's note-taking while you're talking to someone. And while it's taking notes, it may actually say to you that, here's the thing of interest the client might be interested in. All error, all customer service. It's a little bit of everything.
But it is going to replace some jobs.
Of course, yeah. But I look, folks, people have to take a deep breath, okay? Technology's always replace jobs. Your children are going to live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind. But, planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things. Think of cyber. Henry Kissinger talks about warfare. But the fact, and I do think eventually have legal guardrails around it. It's kind of hard to do because it's new, but it will add a huge value. And for JP Morgan, if it replaces jobs, we hope to redeploy people. Like at First Republic, we've offered jobs to like 90% of the people. They accepted. But we also, we've told them some of those jobs are transitory, but we hire 30,000 people a year. Right. So we expect to be able to get them a job somewhere local in a different branch or a different function if we can do that. And we'll be doing that with any dislocation that takes place as a result of AI.
The biggest tech companies prop up a huge chunk of the S&P. Is big tech too big to fail? I
think that's a too broad a question. I think in any industry, you say too big to fail, which I've lost touch with what that really means anymore, because remember, car companies are bailed out, and these things are bailed out, and I don't understand. They should ask what they want. If the regulators don't want a bank to ever fail again, then we should do A, B, C, D, and E. If that's the goal. I didn't think that was the goal. I think Dodd-Frank actually accomplished most of the goals, which is dramatically reduce the risk, create liquidity, capital, stuff like that. So, and big tech, you got to be very specific. Sometimes companies misuse their position, and sometimes they don't. Sometimes regulators capture it, sometimes they don't. But they're powerful, and we have to deal with that. I've been writing about, big tech going to our business. We got fintech, but we also have big tech, and they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
I wrote about it. I wrote about it like 5 years ago.
Well, how worried are you now?
Like, what is a bank? Well, we're going to compete. So they have a tough competitor, but they hold money, move money. You can put money in basically markets, but it's a white labeled checking account, credit card, all these things. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people. So,
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
All right, an exclusive conversation there with Jamie Dimon, the CEO of J.P. Morgan, and Katie Greifeld. You heard it there first. He was up on Apple Bank long before the kids knew it was cool there.
He wrote about it 5 years ago.
I know. I have to look this up. I don't know exactly what he wrote, but I'm glad that Emily asked that question, though, because it is a legitimate one, right?
Yeah.
I mean, we talk about how a lot of these traditional banks are really just getting battered on all sides. You have, obviously, a lot of the private capital firms stealing a lot of the deals businesses, and then you have these sort of quote-unquote fintechs out there trying to steal a lot of the consumer business.
And then you think about on the deposit story, which matters less for the huge banks, but now you have money market funds competing with them as well. A lot of interesting comments to pick out there. Of course, some of the people that they hired, their jobs were transitory. And I also thought the point that he made that, okay, on AI, take a breath. Technology has always meant job churns, people's jobs change, and AI is no different.
Yeah, it's no different, and he makes the point here. This is kind of the long game, right? I don't think anyone doubts the promise of AI. I think what they doubt is sort of like more the time frame, right?
Yeah.
This idea that it's either going to lead us to salvation or destroy us all are just kind of these extremes that don't take into account the nuances. And as he points out, like a lot of CEOs point out, they've been using some form of AI now for years.
Yeah. And I mean, in all of these conversations about AI, I just think about, like, what were the takes like when the internet came about?
Oh, they were pretty bad.
What were we saying? I'm glad that I wasn't on television making some of those takes. But in any case, coming up on the close, Congress
Where's Brian Gumbel and Katie Courier?
I don't know. Congress avoiding a shutdown for now. We'll have the latest insights from the Conference Board survey
Are they actually
of
working
CEOs.
Now? Oh, that's from Saturday.
That's from Saturday.
Oh, they're not actually working
maybe we can get a live cam on them. In any case, we're going to get that survey. More on what leaders are most concerned about and how many are preparing for the next deadline. This is The Close on Bloomberg.
All right, the U.S. is avoiding a government shutdown for now. The Senate passed the last-minute 45-day funding bill just 3 hours before the midnight deadline on Saturday. Ahead of the last-minute deal, the Conference Board surveyed CEOs for their take on the uncertainty and congressional gridlock. Pleased to say that Lori Esposito Murray is joining us right now, president of the Committee for Economic Development at the Conference Board. And I do want to start off with that survey, of course, done at the end of last month, or released at the end of last month. And obviously, we sit here now with at least a shutdown averted. But most of the responses that you got in that survey, Lori, seem to suggest a lot of concerns here, not only about the potential for a government shutdown, but about the economic impact as well.
Well, Romaine, thanks for having me. And I just want to clarify that this poll, this survey, was just released September 29th. So it was over the previous week, just right before the weekend shutdown or debate over the shutdown. So what's really fascinating about the numbers that came out, 91% of the CEOs and board directors that were surveyed believe that if there was a shutdown, it was going to hurt the economy. And so we're looking at this real short time period now of 45 days, really difficult issues that have to be overcome, never mind the politics that's involved and the political chaos that may ensue. 91% of our CEOs said that a shutdown would hurt the economy. 44% were already changing their business plans, which is pretty significant. And so you're looking at a very fragile economy as we're trying to recover. And you've already got 44% of the CEOs and board directors that we surveyed already changing their business plans in anticipation of what might have happened this weekend, and of course, may happen in 45 days from now.
Well, I am curious. There was another point out of that survey on the question of creditworthiness of the U.S. government here, with the caveat, of course, that this isn't the first time we've been here. We've dealt with the potential for government shutdowns multiple times over the past decade. Of course, we just came off the whole debt ceiling debacle just a few months ago here. There does seem to be a broader concern here that the cumulative effect all of this could really sort of impact, I guess, just how investors view the United States government.
Exactly. And so it's not just the immediate impact on GDP or the longer term impact on GDP. It's actually bigger than that. It's about the credit worthiness. 82% of the respondents are concerned that the shutdown will adversely affect U.S. credit worthiness. That's a really significant and a very high number. And you already had Wells Fargo's and Moody's saying that it might affect the dollar and it might affect U.S. credit worthiness. And of course, that's on the cusp of having our credit worthiness downgraded because of the banking situation. So really fragile, vulnerable economy as we're trying to recover.
Lori, I'm glad you brought that up because that's what jumped out to me as I was looking through the results because, of course, when we got that downgrade this summer, and we'll see, of course, if Moody's follows, but the big question was, what does this mean in practice? Is anyone going to be reluctant to buy U.S. Treasuries because of this? So when you think about some of these respondents to the survey, when they're worried about U.S. creditworthiness, how this will affect it, what does that actually mean in practice?
Well, Katie, it really affects the overall confidence in the economy by business leaders and by investors. So you're dealing with a large-scale response that's more about as opposed to direct number hits. It's more about what is really going to start cracking the foundation of confidence in the U.S., confidence in the U.S. dollar, confidence in U.S. creditworthiness globally. And so it also affects U.S. leadership. And you can't ignore what's happening with the Ukraine funding in terms of our allies and partners getting concerned about the ability of the U.S. to lead on these really important global political issues as well.
Well, Lori, in the minute we have left with you, let's talk about where we go from here, because this is a little bit of an optimistic note. The fact that 87% of respondents believe that a bipartisan congressional commission on fiscal responsibility would actually help, at least when it comes to the national debt.
And that is really significant because it's pointing to the only way we're going to get out of this problem that we have and out of this particular fiscal problem we're dealing with right now, never mind the $33 trillion of debt that we're carrying, is through bipartisan collaboration. And the headwinds are strong, working against that. On the one hand, we got through this with that collaboration. On the other hand, you have the threat to vacate the speakership, and you have different numbers, baselines coming out of the House and the Senate, billions of dollars apart. So, but you're only going to break through that with bipartisan support, and the commission can get you through the longer-term issues.
All right, Lori, great to catch up with you. Lori Esposito Murray there, president of the Committee for Economic Development at the Conference Board. And we're going to stay on this topic all day long. A little bit later today, we're going to have a conversation with Congressman Matt Gaetz of Florida. Of course, one of the main impediments here that actually led us to the brink of a government shutdown. 5 p.m. New York time, the team at Balance of Power will have a sit down with Representative Matt Gaetz. This is Bloomberg. This is the countdown to the close, a focus on the broader market, back on the back foot once again here. But let's check in on what's going on with commodities here as we wait on settlement of NYMEX crude futures. Here's our commodities close. WTI futures down right now for a third straight session here, and at one point on the day at 88.82 and change. You're right around the lows of the day as we wait for the final numbers to come in. This really isn't a supply story anymore or even a demand story. This is really about the trajectory of the dollar and the trajectory of yields. Higher on both notes here. And that's a big part of the reason why you're seeing the downdraft in crude. A big part of the reason why you're also seeing a downdraft in industrial metals, with copper pulling back here once again over there in London, down about 2.7% here on the day here. A big shift and right now a big focus here on the lack of boost that we got out of China, a lack of boost that we've got out of some of the other big industrial economies, and whether the U.S. at all is going to play a factor and maybe righting those wrongs. Gold futures also down here right now, testing one of the key technical levels to the downside, and you're starting to see a flip-flop here in wheat futures here, moving higher by a pretty significant amount, up about 4.6%. And that's kind of clawing back some of the losses that we had after last week's U.S. Department of Ag numbers that seemed to show that some of those inventory issues would actually depress prices. Katie Greifeld, but just like you today, green on the screen.
Green on the screen. Well, let's go from the commodity market over to the labor market, because with the UAW expanding its strikes against GM and Ford, there are growing concerns about the impact on the broader U.S. economy. Now, according to an analysis done by Bloomberg Economics, if the strikes were to broaden out to all 150,000 UAW members, a 2-month stoppage would knock 0.4 of a percentage point off fourth quarter GDP growth, and a strike lasting a full quarter would cut 0.6 of a percentage point. For more, I'm thrilled to say we're joined by Bloomberg Economics chief U.S. economist Anna Wong on set, a rare treat. Anna, walk us through the relationship there. How does this broaden out from something going on in the auto sector into something that's an issue for the broader economy?
So, you know, Katie, the auto industry is one of the most complicated industries. So only 30% of the production value of a car is really sourced within the auto manufacturing industry. The rest of it is drawn from industries like rubber, plastic, steel, and even services management. And so when you have 25,000 auto workers on strike, the impact is not just confined to the auto industry. We estimate, using the input-output tables released by BLS and BEA, that, you know, a 25,000 strike, a narrow strike, could ultimately lead to about 130,000 layoffs. And this nonlinear spillover effects could happen if the strike starts to extend beyond 1 month period. And if all 150,000 auto workers were to get into a strike, 760,000 workers could be laid off as a result.
Forgive me if this is a dumb question, though, but a lot of these plants are concentrated in a small handful of states here. Does that minimize the impact of it?
No, it actually, not from the perspective of those states. So a lot of these plants are located in the Midwest, and those states actually have been doing pretty well in the last 2 years with low unemployment rate. But with all of this 760,000 potential layoffs, if they were to be concentrated in Michigan and, you know, Missouri, you would actually lead to some severe economic downturn in those states.
And so when it comes to the potential layoffs that could be produced as a result of these strikes, what happens when the strike ends? Do those jobs come back?
Yeah, so a strike is just a temporary shock. You could think about it as transitory, really. So after those strikes end, yes, those jobs would come back. However, the longer the strike lasts, it would create more uncertainty, and people just don't spend when there's uncertainty. And there's actually a foregone economic activity as a result of you know, those strikes.
All right, Anna, it's great to see you. I'm sure we'll be checking in with you in just a couple of hours. That is Anna Wong of Bloomberg Economics. And it's a great piece of research, Romaine, because, of course, it's tempting to think of this as just an auto sector problem. But then you think about everything that goes into a car. It's a lot of the economy. Everything
that goes into a car. As she was speaking, I'm surprised we didn't ask her about this here. But is it possible we can get Taylor Swift and Beyonce to do a new tour? Because I heard that added a lot to GDP, apparently.
I know, maybe that would do it. That would
I mean, Anna's like, oh, people don't spend if there's uncertainty. Did she go to the Jets game yesterday?
She did, yeah.
Yeah, there were a lot of people who knew nothing about football who were spending a lot of money on football.
I was on Twitter, you know, watching the live tweeting. I don't think I've ever done that for a football game. So I don't know, maybe we can work something out. But still ahead, before we get there, a New York State Supreme Court justice ruled against DoorDash, Uber, and Grubhub after the delivery apps challenge NYC's minimum pay rule. Up next, we're going to discuss what this means for the gig economy as cities make similar moves. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off here with U.S. Steel, an upgrade today to overweight over at Morgan Stanley, and that's coupled with a new street high price target of $40 a share. The analyst citing the company's investments in electric arc furnaces as well as other spending that he says should support growth in EBITDA and free cash flow. Shares fractionally higher on the day. Next up, Piper Sandler adjusting its stance on cloud software companies, lifting its rating on Zscaler and Datadog to overweight from neutral. The Datadog upgrade reflecting growth across security and AI segments coupled with stable demand for infrastructure and development software. The shares fractionally higher on the day as well. And finally, an interesting call on McDonald's. Citi cutting its price target to a street low $283, down from $317. But the analysts over there are saying that all signs point to slower foot traffic. He says U.S. engagement is down, and the June marketing campaign featuring the character Grimace may not have done enough to accelerate growth. Shares down 2% on the day on McDonald's, and those are some of our top calls. We want to stay in the sell side space and take a look at some of the delivery companies, because pretty soon the food delivery workers that deliver McDonald's through services like Uber Eats and Grubhub's, they're going to have to be paid more, at least here in New York City. The firms lost a challenge, barring the city from implementing a minimum wage rule, which forces them to pay couriers almost $18 per hour minimum. Mizuho analyst James Lee joining us right now to talk a little bit more about the potential effects on these companies. He's got a buy rating on Uber and on DoorDash. And James, I guess the big question goes here, $18 an hour for one particular city, which I assume would make up a fraction of their overall business worldwide, or here in the U.S. at least here. How much of a material impact could this potentially have?
Hey, Romaine, thanks for having me. Yeah, you're right. I think the impact's rather limited to both Uber and DoorDash. They have spoken in the past that New York City makes up only single digits of total revenue exposure. So therefore, the impact will be rather limited. I think going forward, we see, what happened in New York City as a way, actually, if you look at the positive side of the validation of the independent contractor plus business model. Right, we see that happening throughout the country. We recently saw negotiation successfully between gig economy and the state government of Washington. We also saw people actually voting for Proposition 22 in California. And we also saw in the UK, they actually create a separate class for worker class, which is pretty much equal to IC plus type of model. So industry going forward, I think the biggest question is whether we are changing from independent contractor, to full-time employment. At least right now, looking at the regular trend, seems like we'll be moving in the IC plus type of business model, which is typically very favorable for DoorDash and also Uber as well.
Well, give us a sense why it's favorable, because we already heard from, I believe it was DoorDash last week when the ruling came out, the idea that they're going to basically pass that on to the consumer. And anyone who's ordered off these platforms know there's already a plethora of fees here that can really escalate the overall cost of your meal. What's the balance for DoorDash and Uber, Grubhub, and all these companies with regards to how much it actually costs to get that food delivered to you, and when customers start to just say, I'm going to cook myself or go pick it up myself?
That's a fair point, right? I think both companies think New York pretty much as an exception, right, given the increase. And if you look at the assumption behind New York City's calculation for delivery minimum wage, it's actually somewhat flawed. The thesis or the calculation is based on TLC's taxi driver costs. If you think about driving a taxi, right, that the operating costs a lot heavier than delivery workers. For example, they're mostly on bicycle or motorcycle in New York City. So obviously the operating cost in New York City is a lot cheaper. So therefore, I think there's an opportunity for negotiations between New York City and gig economies going forward, even after this ruling, number one. And number two, if you look at DoorDash specifically, they've been very proactively giving delivery worker a different option to get compensated. In various cities throughout the United States, they give an option of pay by time in terms of pay by delivery. And the pay by time assumption really based on minimum wage of each particular city. I think DoorDash is actually very mindful in terms trying to mitigate, minimum wage risk in different cities going forward. I think Uber may also pursue that direction as well.
Well, James, that's what I wanted to ask. When you think about Uber, you think about DoorDash, is either one of those companies better positioned here to deal with these higher costs?
Yeah, I think both companies are very well positioned. And the key reason is both companies are gaining economies of scale when it comes to delivery, increasing that network density. And when you're able to achieve that network density, what you're able to do is drive efficiency into the delivery system. For example, I think both companies recently were working very hard to reduce what they call a defect rate, the rate of return, rate of exchange. By doing so, they can increase their unit economics and either cover the additional cost when it comes to minimum wage, in this case in New York, or potentially, pass the savings to customers.
And James, you did make the point that when you think about New York City, it's single digits exposure when it comes to both of these companies' bottom lines. But when you think about the risk that other cities could follow New York, how much of a concern is that for the likes of Uber, for DoorDash?
Well, this is certainly a topic we look at very carefully, right? And that's why I think it's very important for a company like DoorDash taking initiative to provide to delivery workers, what they call dashers, a different way to get compensated. If you go DoorDash, for example, in Philadelphia, you can go into the app as a delivery worker and choose you want to get paid by the hour or you want to get paid by delivery. And the pay by the hour, methodology really based on minimum wage of that city specifically. And this is a way for DoorDash to really mitigate any potential risk. And that's why I believe probably, Uber will evaluate that business model and potentially follow that suit as well. I think there are three things we're looking at very carefully in terms of looking at gig economy company. I think the bigger risk for them is not necessarily minimum wage. The bigger risk is for the government, especially the federal government or the state government, to reclassify, delivery worker from IC, independent workers, to full-time employment. Costs can go up meaningfully. And we see three events coming up in the horizon. One is the pending nomination of the head of Department of Labor, Julie Su. Now, Julie is currently the vice commissioner, and she used to be head of Department of Labor at California. Looks like she's not getting enough support in the Senate to get nominated. I think that's good news. Another thing is Massachusetts. We have the ballot very similar to California. That'll be voted in November with 70% of the drivers' support. Wow. And the last one is city government. At this point in time, they're currently negotiating 3 major unions to add a labor surcharge or union surcharge on a per ride basis in order to mitigate that. I think those are the right direction where the gig economies are pursuing, which will be very favorable to them going forward.
All right, James, going to have to leave it there. Great to catch up with you. Great insights. James Lee there over at Mizuho. A closer look at Uber, DoorDash, and some of the delivery companies affected by some of these new minimum wage laws. Coming up here on the program, Aaron Brown, formerly of AQR, the chief risk officer there, now a Bloomberg opinion columnist, has some thoughts on how Wall Street is handling the SEC's WhatsApp probe. That conversation coming up after the break. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston, who joins us every day around this time. And David, we closed out last week with an interesting settlement by the SEC with a bunch of big Wall Street firms. And this is over the way that some of their employees communicate either with other peers or with clients, apparently using WhatsApp and other forms of communication that I guess technically weren't authorized, or were they?
These personal messaging. We're going to find that out. But I mean, I've been following as you have too. They're well into the billions now in those fines between the SEC and the CFTC. But now we have an authority who answers the questions that you have. Romaine, he's Aaron Brown, former AQR chief risk officer, and now a Bloomberg opinion columnist. So thanks, Aaron, very much for being with us. First of all, what is the rule being violated that the SEC is going after?
Well, there are two of them. They're both from 1948. and so when you try to interpret them today, they don't make a lot of sense. They were basically saying if you have memos, if you have letters, if you have agreements, you have to keep copies so the SEC can look at them for 3 years. But the SEC suddenly decided in 2020 that all written business communication, including text messages, emails, and WhatsApp, Signal, LinkedIn posts, all of those were covered. Nobody ever really thought that. They knew you had a firm-issued phone or a firm-authorized phone and those text messages would be kept, and obviously your firm emails would. But they didn't think you had to keep track of every informal communication you made with any colleague or client.
But Aaron, you're just pursuing that. If you knew that your firm issued phone had it and your emails were covered, isn't there a moral hazard there to say, okay, fine, don't use those anymore, figure out some other way to go around it?
Well, if you think about it, almost any communication in business with a colleague or a customer is going to combine some business and some personal. And some of that personal is going to be things like talking about a job maybe you're thinking of taking, or making a joke, a political comment, something you don't want to see on Bloomberg TV, or you don't want your employer to be looking at. Maybe you're griping about your boss. And so people had an idea that, okay, you can have a recorded phone conversation, in which case you're very careful about what you say, or you can, have a chat over lunch, in which case you can kind of cut loose a little bit. Again, in 1948, there was no, everybody knew what the difference was. In a modern world, there's sort of a continuum between formal business communication, signed documents, firm emails, and casual chat stuff.
Well,
yeah, go ahead.
Well, that's what I'm curious about, Aaron, as to why the SEC basically chose to take an existing rule and try to interpret it for modern times. Of course, a rule, as you point out, that came about in the 1940s, rather than just create something new to address the fact that we communicate much differently today than we did back in the 40s.
Yeah, if the goal was to stop people from illicit communication, this is obviously ineffective. The day you start, running everything through your firm compliance department, people are going to shift the illegal stuff to some other, some other way of communicating. So it's not going to do anything to stop that. What it is going to do is just kind of sour everybody a little bit on the SEC, that it no longer seems like something run by rule of law where they tell you what the rules are. It's something where they, like a speed trap, where they have a hidden speed limit sign so they can get all the out-of-state motorists for $100 fines. And that's what this feels a lot like, the SEC just collecting fines without ever showing anybody did anything wrong or anybody deliberately violated any law.
I am curious about the banks in this here. As we know, of course, a lot of those banks have their own rules about communications. Now, some of those, to be fair, are created in direct response to the regulations out there to make sure they don't run afoul. But we know some banks actually have stricter regulations, particularly when it comes to investment bankers and those who are working on sensitive deals.
Well, certainly any sensitive information. Okay, so we're two different things. You can't tell people about, confidential mergers, regardless of how you communicate it. Even if it's like a whisper in the bedroom at night, you can't do it. But this is just about a means of communication, even if the information is entirely innocent, if it is business related. So, if you're going to meet somebody for lunch, a customer for lunch, and you're going to text him, I'm going to be 15 minutes late, is that business related? Nobody really knew. People thought you could do it. If you're not texting him, hey, there's a merger going on that you can take some insider trading on. So that's what I mean, that, nobody really knew what the line was between the two. There are strict lines. There are things that are just wrong. Giving inside information is just wrong, and everybody always knew that. But now the problem is, if you use a communication channel that was not recorded by the firm, you're sort of presumed guilty, even if you sent only entirely innocent messages. And let me emphasize, the SEC has no evidence anybody sent any illicit information on any of these channels.
But Aaron, put aside for a minute, however we got here, whether it should have been by rulemaking rather than by enforcement, we're here where we are now. That speed trap is no longer hidden after billions of dollars in fines. Going forward, isn't this a reasonable approach?
No, because there's going to be something else, right? So people will stop using Signal and WhatsApp, but, they're still going to, holler over the desk to somebody saying, how are your kids doing? And the SEC could come in tomorrow and say, that's now, all of that has to be recorded, all your other things. Because there is no rule of law. It isn't that there's a rule and it's clear and everybody knows it and you're only prosecuted if you violate it knowingly. We now have this rule of SEC fiat that can come down after the fact and get you for stuff.
Okay, Aaron, thank you so much. Really great to have you on this subject. That's Aaron Brown. He is Bloomberg opinion columnist and former AQR chief risk officer. And Romaine, tomorrow we're going to hear from Ray Dalio, Bridgewater Associates founder at the Greenwich Economic Forum. And on Friday on Wall Street Week, we'll be joined by Glenn Hubbard as well as Larry Summers, two economists, telling us where we are right now in the economy. That's coming up Friday at 6 p.m. New York time.
All right, another great lineup here for Wall Street Week. Be sure to check that out every Friday. And David joins us every day around this time, right here on The Close, as we round out into the final hour of trading, as we start a new week of trading, of course, a new month and a new quarter as well here. And we're pretty much leaving off where we left the month of September behind here. A mixed day in equity markets, but the real story is what you're seeing in the yield space, meaningfully higher pretty much across the entire curve. Strength in the dollar as well, and that's causing a revaluation here in the equity space. The VIX elevated, WTI crude pulling back. Stick with us. Romaine Bostick alongside Katie Greifeld. We're counting you down to the close. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Let's get a view from the top here, Katie Greifeld, because it came into today and it actually looked like this market was ready to rally. A little bit of relief, of course, that the U.S. government didn't shut down. But then I think when people looked at the details and realized they're just kicking the can down the road for 45 days, maybe that caused some concern. Maybe the 11, 12 basis point jump in benchmark yields caused some concern. Maybe 6/7% gain in the dollar caused some concern.
Yeah, there's a lot of things to maybe get worried about right now. I think the point about rates jumping, there was no government shutdown, no haven bid as a result. That's probably not helping sentiment out too much. You're looking at the S&P 500 off by about 0.5%, and volume is back today.
Volume is back, and you see the oil stocks down pretty significantly, and that's largely on the back of the downdraft in oil. But I want to point this out on the screen there. The Russell 2000 is down about 2% right now, and obviously some of that is because of the oil stocks, but you're seeing an overall sort of unembrace, if you will, of that cyclical trade that it looked like last week some people were willing to maybe hug.
Well, that's the thing that I want to get into with the small caps. We worry so much about maturity walls, refinancing risk in this higher rate era. How much more of a concern for that is one of these typical small cap companies versus some of these big large cap companies? Yeah,
flip up the board, too, because the dollar is playing a big role in this as well. It is significantly higher here on the day. And this was after, of course, we had a few months where it looked like people thought that the path forward for the dollar was lower. But now you look at the latest CFTC data, the hedge funds out there betting once again for the second week in a row that you need to be long dollar in this environment.
And at least it's working out for today. We'll see how the next couple of weeks, next couple of months goes. But let's talk about some of the big movers when it comes to the equity market today. This is a really interesting one, Romaine. Smile Direct Club. 64%. It filed, of course, for Chapter 11 bankruptcy on Friday.
I'm so perplexed by this.
I know. Well, it's amazing when you think that this comes just 4 years after raising $1.35 billion in an IPO. It hasn't turned a profit since.
Yeah, we got to dig deeper into this on another show, because this has to be one of the bigger flameouts from that new crop of companies that came up. It seemed like they were all the rage for a while.
I know.
And then nada.
I saw some of their commercials, et cetera. Yeah, not too pretty right now, and down 64% today. Let's talk about NVIDIA, though. That's a different story. It was added to the Goldman Sachs conviction list. The firm sees strong long-term growth prospects.
Bold call.
There you go for NVIDIA. It's up 2%. Price target is $605. So a lot of daylight there. And let's quickly talk about Norfolk Southern. 2 outages over the past week for this rail company, and Bank of America downgrading the stock from buy to neutral today. And this company, it'll be interesting. They report later this month.
I'm sorry. Can we go back to NVIDIA for a second? You said 600 and something is the new price target?
That's the price target.
That's huge, right?
It is.
I mean, isn't that like a 50%? I mean, my math isn't great.
I can't
but
back check you there. But
so.
Yeah.
Did you never learn how to do it? Like, what's the method they call it?
If I did, it's not in there anymore.
Oh, okay. Did they not teach that in New Jersey high schools?
They might have.
Okay.
I wasn't paying attention.
All right. We are 1 hour away from the closing bell. Our cross-platform coverage, counting you down to that close, that coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, our partnership with YouTube, and I'm sure I'm forgetting a few things there. Carol
Big
Massar.
screens at AMC. How's
Metaverse.
that?
Oh, nice.
Wow.
That's
There
a
you go,
deep
Tim. I love it. Can we do counter programming with Taylor Swift and Beyonce?
I would not want to be up against either of them.
We could win.
You think so?
I mean, if you have the right attitude, Tim, not with that attitude.
You know who could win?
Yeah.
I think we are living in Taylor's world. We're living in Beyonce's world. But what about living in Jamie Dimon's world? Because when he speaks, we all pay attention. He has what?
He's in a good world.
He is in a good world.
It's a charmed life.
He's in a good spot. Like, he's the only remaining big CEO of a big bank that was there during the great financial crisis. So when he speaks about things, we know he has seen some cycles on Wall Street and in the U.S. economy, and he did weigh in on all of that with our Emily Chang earlier on Bloomberg TV. He said the economy's still okay. It's strong. That's the here and now. And then he also talked about that higher rate environment. Here's what he told Emily and Bloomberg TV and radio.
Can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7 over the 10-year bond now. Yes. Is supply and demand could push high? Yes. I'm just saying, be prepared for it.
Be prepared for a lot is, I guess, what we all have to be. Jamie Dimon, of course, of J.P. Morgan. I think, though, that was interesting. But what I kind of really was blown away by
let's hear it.
Was Jamie saying that we're all going to live to 100, basically.
We're not. I have bad news. We're not going to live to 100.
All right, the next generation.
I have bad news, Carol.
Well, maybe.
Our kids.
Maybe.
Our kids will live to 100.
Do we really want to live to 100?
Yes.
Yeah.
He said AI will help us make, live to 100 and be cancer-free. And then the 3.5 work week is really what I want to be talking about.
Yeah, I thought that's where Carol was going.
Why the extra half day? Why can't it just be a 3 work?
I've done 2 different shows. I've done 2 shows today. So has Tim.
Yeah. Well, it's like, what's the point of that half day?
What does that mean? You're taking off the rest of the week, right?
Yeah. Well, if only. Yeah.
Well, let's talk about something else that's near and dear to my heart, Katie Greifeld.
Yeah, I know. Thank you again for doing that segue for me. We've already talked about it, but Renaissance, a film by Beyonce. It's going to take over movie theaters, according to this AMC press release, starting December 1st. Of course, Romaine went to the Renaissance tour. It was a 56-performance, 39-city, record-breaking world tour, and now you can see it in theaters, similar to, of course, the Taylor Swift's Eras tour, which I believe is starting this month.
Well, that's what I'm curious about. So they're putting a little distance between these two.
Bit,
It would have been nice if they could just done them together, and instead of what was it, the Barbie Oppenheimer, you could have, Beyonce and Tay-Tay.
Yeah, let's not pit powerful women against each other, though. I think I like spreading it out.
We're pitting the fans against each other, who I know love each other.
I actually have a serious question.
Okay.
Yes.
Because this is something, and same with Taylor Swift, this is a way to make her concerts accessible to people who weren't actually able to go to the tour. Romaine, you went to one of Beyonce's shows. Would you go then see the movie?
Well, I was just having this conversation with Katie Greifeld during the commercial break. I've never seen a Taylor Swift show, so that I would actually go see on the big screen, just because I'm curious and I'm not going to pay. I don't like her enough to pay $1,000, whatever she was charging for tickets. But no offense to the Swifties out there.
I mean, it doesn't have for me. It's not about liking her enough. I mean, I like her enough to do that. I just won't do that.
You just won't do it.
I'm not going to pay $1,000.
Yeah. And it's been a while. I went to AMC. What did we saw? We saw Oppenheimer.
You saw it. Did you see Barbie?
No, I saw Oppenheimer, but it wasn't. I've been in AMC ever since the whole, the little retail horde got a hold of it here.
Was that a choice that you made?
They have free refills on popcorn. I got an icy. I haven't had an icy in years.
No kidding.
Romaine's the only one whose consumer behavior reflects the meme stock crowd. It's like, I'm not going to go because it was a meme stock.
Is that a principle?
Respect.
Jamie Dimon's calling. I want my world back.
When is Jamie Dimon's movie? He's got a great story. Started his career in Chicago.
All right. On that note, we'll come back.
Hold
we will
that
not come back.
I'm going to write the treatment for the Jamie Dimon.
Beautiful.
Katie, no more coffee for Romaine. No more coffee.
He's in a great mood.
I would watch that.
It must because it's the fourth quarter. All right, guys. We're going to be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, and of course Bloomberg Originals. We're going to count you down to the first trading day of the fourth quarter. Join us at 4 p.m. Wall Street time.
We continue our markets coverage right here on Bloomberg Television, counting you down to the close. A little more than 50 minutes until we get there, with the equity markets on the back foot and Treasury yields higher here on the day. And a lot of questions right now about how much we can read into economic conditions as well as into the broader credit market. Winnie Cisar joining us right now, global head of credit strategy over at CreditSights. And Winnie, always great to talk to you. And let's just start off right now about credit market conditions here. And I think that we've posed this question to you before here, but when do we actually finally see any sort of cracks, if at all?
Hey, Romaine, good to talk to you today. So we've seen some cracks in the credit market. We do have a rising default rate, mostly those higher leverage, lower rated issuers that were already a little bit in trouble coming into this higher rate environment. More recently, we have seen spreads start to widen out a bit as we're adjusting to this higher yield environment. We do expect that spread widening to probably continue in the near term. But once we get through probably November, perhaps that next government shutdown threat, we actually have a much rosier outlook for corporate credit.
When we talk about sort of, I guess, where we are in this economic cycle, Winnie, or at least where investors think we are, where do they think we are?
So this is an interesting one. It really depends on which investors you're talking to. We have spoken to a lot of investment grade investors who are very cautious. They've immunized portfolios, gone up in quality. They're trying not to expose themselves too much to duration risk or credit risk, which is really quite tricky to do. But when we talk to some of the more leveraged finance investors, they actually have a much sunnier outlook. So I think that there's a pretty big disagreement over where exactly we are in the cycle. Our view is we're kind of in the middle. We've seen a lot of bumps already. We've seen some pretty material choppiness in some sectors, and now we are seeing recovery in some of those sectors, things like technology and home building. But then we do have the consumer kind of looming as the next potential threat.
And Winnie, I'm looking through your notes, and you write that despite tight spreads, valuations in credit markets are quite attractive on a yield basis. And this is kind of the thing that I've been obsessed with over the past week. When you're looking at the credit market, you're sizing it up. Are you paying more attention to the fact that yields are the highest level that they've been in maybe a year, maybe a longer? Are you taking a look at those spreads and saying things look a little stretched here?
Well, Katie, this is the big debate going on in the credit market right now. And I think that you have to balance both things. And then you also get to throw in prices as another facet of the conversation. Because when we look in investment grade, especially in the long end, those 10, 20, 30-year maturities, you have a lot of very highly rated bonds trading at a pretty significant discount. And if you have a pretty high conviction that those companies are going to be around to repay their debt in 10, 20, 30 years, then that looks like a pretty good buying opportunity. But when you look down at high yield, specifically triple Cs, and look at spreads trading at pretty tight levels, and spreads really in triple Cs have recovered or rallied the most this year, that makes us a little bit more cautious on kind of the spread versus yield conversation for some segments of the market.
And when you think about that recovery that you've seen, how do you think that's translating into the private market? Of course, we spend a lot of time talking about the public market, but it feels like every other day there's some huge story coming out about so-and-so raising a ton of money in private debt. When you think about that recovery that we're seeing in maybe loans, maybe in some of these triple Cs, how does that translate?
It's a great question because the private market has seen so much capital attracted to it over the past 24 plus months. And there is a lot of benefit in having portfolios that are actually a little bit less liquid, a little bit less susceptible to the rate volatility that we've seen over the past couple of years. Now, that being said, looking ahead, you do have to have some questions around the fundamental health and the fundamental quality. We know that leveraged loan fundamentals are worse than high yield bond market fundamentals. And we can presume that much of the private credit market, given that it is smaller companies that are probably a bit more highly leveraged, are even worse in shape in terms of fundamentals relative to leveraged loans. So long as you know what you're buying within private credit, there's probably some good opportunities to have that balance of yield, a little bit less liquid and less susceptible to some of the volatility that we've seen. But I do have some concerns around kind of the broader fundamental health of that space.
Should we expect to see a little bit more stress among the borrowers, those folks who maybe are sitting on high debt servicing costs already and need to come back to market for more? We were talking a little bit earlier about a bankruptcy today, and there's been a lot of discussion here about these so-called, I guess, zombie firms, for lack of a better phrase here, that are still kind of feeling around in the dark.
Yeah, and the feeling around the dark, I think, is probably going to continue so long as the Fed is saying that they're going to be quite restrictive and quite hawkish. Now, I think that for companies that are sponsor-backed, to have a private equity sponsor, there is the opportunity for sponsors to raise more capital and kind of kick the can down the road to help with some of the near-term liquidity challenges. For those that don't have that sponsor cushion, or those that have public equity, it's a much more challenging prospect. If there's some sort of fundamental or secular issue within your sector that's not going to allow you to refinance at a level that means capital structures are still sustainable going forward.
All right, Winnie, it's always great to catch up with you. Really appreciate your time on this Monday. Our thanks to Winnie Cisar. She is Global Head of Credit Strategy over at CreditSights. Now, coming up on the close, no government shutdown for now, but what happens in November? We're going to get some insight from Andy Blocker, Global Head of Public Policy and Head of U.S. Government Affairs at Invesco.
And this could be potentially a big week for crypto. Bitcoin higher on the day. Meanwhile, Sam Bankman-Fried, the former FTX founder, his trial set to start as well. We're going to get a preview on what's at stake for the crypto sector.
And the latest entertainment sensation in Las Vegas opens with a concert by U2. Oh, my goodness. And look at that sphere. It looks amazing, and the shares soaring today. We're going to have the latest. Can you see the concert from outside, or you have to go inside? No, you have to be in the sphere. I would live in there if I could. We're going to have the latest. All that and more coming up. This is The Close on Bloomberg.
Session lows for U.S. equities right now as we march towards the close. You take a look at the green behind me here. Most of the Magnificent Seven solidly in the green. In fact, a lot of the big cap tech names are doing well on this day. But to give you a sense of just how much power you're seeing right now by some of the smaller cap names here, it's a big part of the reason why we're down about 0.4% on the S&P and almost 2% on the Russell 2000. A downdraft in small cap stocks, a downdraft in cyclicals, a downdraft in equity names, a downdraft in biotechs, to be sure. Some of that is related to economic conditions, but it also related to what we're seeing in the yield space. 5.10 right now on the 2-year yield. And you take a look at a 10-year yield, a 30-year yield, up 9 basis points here on the day. In fact, the entire curve shifting a little bit higher, along with the dollar moving higher as well. That's causing a lot of concern right now for investors about the next steps forward. As far as some of the individual stories, you're getting a couple of interesting spinoffs in the market today here, including Aramark spinning off Vestas. Vestas starting trading today. It's down. Kellanova separating from Kellogg. Remember, those companies moving into 3 separate directions here. Kellanova down on its first day of trading. Clorox also down as well. And Tesla, which had been significantly lower in the day, now trying to pare back some of those losses on the back of some disappointing delivery numbers. Katie?
Well, it's time now for Options Insight. We want to get you up to speed with the day's options trading, and we're taking a look at third quarter volatility spreading right into the fourth quarter. Alon Rosin, head of derivatives for Oppenheimer, joins us now. And Alon, let's talk about the read-through from the bond market, because I'm taking a look at 10-year Treasury yields. They were up something like 80 basis points in the third quarter, up another 10 basis points today. How is that translating through into the options market?
We continue to see a lot of investors piling into TLT and upside in bonds, thinking that at some point it will reverse, but it's not. And it's clearly been a big pressure on equities, outside of what Romaine mentioned earlier, with Magnificent Seven really keeping the Qs and the S&P 500 up relative to the Russell 2000 and the rest of the, universe for that matter. It's really a problem. Jamie Dimon mentioned that the Fed could see 7% earlier this morning as well. So the negativity continues here, and we're, of course, kind of looking for what's going to stop that. Flow-wise, retail investors think that just because we have higher yields, it's attractive, but from a mark-to-market basis, it's maybe the third time in a very long time that bonds are also seeing a downflow. So as people see their marks, maybe the flows will stop coming in. But in the meantime, we're seeing a lot of buying the dips in bonds.
I'm curious, too, when we talk about sort of the impact of what we're seeing with the dollar alone, obviously sort of reasserting itself in a way that I think a lot of people thought was behind us. And for that matter, of course, that brief resurgence that we saw in energy prices, though, that's peeled back a little bit here today.
No, we think so. We know crude was another big factor that we were looking at as another problem for inflation, another headwind for equities. We got a little too crowded. Every bank, I think, was calling for some pretty ridiculous upside targets, at least from current levels. So we do feel like a little profit taking is in play here. But from an energy perspective, the fundamentals still lean positive there. So we wouldn't be looking to short there. More profit taking in energy right now. But with the bonds not really seeing any bid, we continue to be a seller on strength in equities. Every bounce in the near term, I think, is still to be sold. You know, seasonally, we are coming close to the November period or even earnings where the bar is too low. They could beat and we could get a bounce. But I think over the next, call it 2 to 3 weeks, we could see a chop still leaning lower where we don't think the bottom is in just yet from last week.
Well, Alon, in the last minute or so we have with you, let's have a little bit of fun here because you highlight MSOS in your notes. Of course, that is the Advisor Shares Pure U.S. Cannabis ETF, and it has just been on an absolute tear over the past couple months. How much steam is left in that trade?
Yeah, and I apologize. I think, the problem with MSOS and cannabis, it's actually still not a topic that banks and people are comfortable talking about, so I can't really get into that now. We do like hedging short positions and do believe that the sentiment of positioning is very low there, but we're not promoting any specific trade strategy right now there, but do feel there's a lot of catalysts at the end of the year that could make this come back into play.
All right, fair enough. We'll check back in with you when you can talk about it. Our thanks to Alon Rosin, head of derivatives for Oppenheimer. Our thanks for joining Options Insight today. From New York, this is The Close on Bloomberg. All right, Romaine, let's talk about Sphere. It's the over $2 billion venture being called the entertainment venue of the future. It made its public debut this weekend with 2 concerts by U2. And it's funny that this was a U2 concert because I saw videos of this on TikTok. I just thought it was a visual experience. I didn't even know there was a band playing. It just looked so awesome.
Yeah, I mean, you didn't know there was a band playing. Just a little U2 here, a little local band.
Yeah.
I am curious, though. I mean, we talk about how much money they spent to build this thing. I mean, it's an insane amount of money. And we talk about sort of the longevity of this, the idea that you have not just a music venue, but you're trying to create some sort of experience. And look, that looks cool, right?
That's an experience. That's an experience I would pay money for. I agree. $2 billion, you told me that a week ago. I'd have been like, that is a lot of money. But actually looking at it on the inside, again, it was just, I would love to be there.
Yeah, you would love to be there.
I would travel.
I'm pretty sure you can just go, Katie Greifeld. You know, it's open to the public and they sell tickets for this.
Yeah.
This will be interesting to see how it changes the Vegas landscape, too, because there's always so much competition between these venues to get the bigger artists here. And this is obviously going to be the new kid on the block, so it's obviously going to be, in theory, probably more technologically advanced than some of the other venues.
You also think about competition in terms of the skyline. Now, when you look at the Vegas skyline, all you're looking at is the Sphere because it's this big sphere.
Do people look in the skyline in Vegas? I thought you just stay inside.
I know. Usually you think of Vegas, you think about the casinos, et cetera. But now you have a Sphere just taking all the eyeballs.
It's been a while since I've been to Vegas.
I've never been to Vegas.
You've never been to Vegas?
I would love to go now.
I think they would love to have you, Katie Greifeld.
We'll see. I'm not much of a gambler, but I would go.
Well, that's the whole reason why they built the Sphere. They don't make money off gambling anymore. It's all these types of events and stuff.
Well, I hope a lot more people go and post their videos on TikTok because I will watch every single one. This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie.
And it is none too pretty, and that's the case if you take a look at the sector level as well. There was some green to look at here. Communication services there about 1% higher. Tech too, not having too terrible of a day. That sector up about 0.8%. Consumer discretionary just trying to hold on here. That's all the good news. You take a look down, and there's definitely more red than green. You can see materials, real estate, energy really feeling it today, and utilities in particular getting absolutely slammed, Romaine. That sector currently off by more than 5% on this Monday.
Yeah, let's take a look at some of the individual movers. I mean, tech stocks doing the best that they can here. Meta Platforms up about 1% here on the day, but not getting much help from the other sectors here, including bank stocks. Citigroup actually down about 2% on the day. This despite an interesting note out by Dick Beauvais over at Odeon, basically saying that the company is actually trading at a significant discount here, but he thinks that that growth story that investors are looking for is still going to take another 12 to 15 months to play out before they get a little bit more clarity on its success. Also interesting story with NextEra Energy and its affiliate NextEra Energy Partners here. Both of those shares down about 10-12% here on the day, and this was largely because of what was somewhat of a surprise, where the parent company basically said is not going to have that asset drop down on Next Energy Partners like a lot of investors thought here. So a lot of investors seemingly bailing out of this, at least for right now, as they try to sort things out. Investis, first day of trading for this company here, the spinoff from Aramark. This is basically the uniform delivery company. Those shares not having a good day, down about 14%. Meanwhile, you want to go back here to the broader market and some of the concerns right now about, well, where value is right now. An interesting note out by David Kostin and the team of strategists over at Goldman Sachs, talking about the return on equity for the S&P 500 and rather, well, the lack thereof. That's the white line that you're looking at here. You can see the big spike up that we saw at the tail end of 2022 and into 2023, but it's come down significantly over the past few months and over the past few weeks. It's basically been flatlined. The concerns, basically what we've been talking about a lot, Katie, and that's higher borrowing costs, higher treasury rates.
All right, well, let's go over to the crypto market because there's actually a ton going on this week, kicking off today with Ether futures ETFs making their debut in the U.S., the first of their kind. And the launch comes one day before FTX co-founder Sam Bankman-Fried is put on trial for fraud allegations. So very interesting moment here. And joining us now for more in studio is Bloomberg's Vildana Heinrich and, of course, Zeke Fox, who recently authored Number Go Up, all about Sam Bankman-Fried. But let's start with Vildana and those Ether futures ETFs, because I'll ask you something I asked about 2 hours ago. Is this much ado about nothing? What will demand actually look like for Ether futures ETFs?
The interesting thing about all of this is that the battle to get to these ETFs has been really long and drawn out. We even had earlier this year a bunch of issuers putting out applications for Ether futures ETFs and then days later having to rescind them just because the regulatory and the crackdown on the industry, the environment just wasn't looking as great as I suppose it looks today after we've had the grayscale ruling over the summer and a couple of other cases that the SEC did not end up winning in the courts. But when it comes to whether or not there actually is demand, we can compare it to some of the demand that we saw. Katie, you know this story really well with the Bitcoin futures ETFs, which happened 2 years ago. That happened during the crypto boom. At the height of the crypto boom, there was tons of demand. And so comparing to that period, we might not see the same exact demand that we saw back then. BI, Bloomberg Intelligence, said it's not going to be a nothing burger, but it's not going to be the same as we saw back then.
So not a nothing burger, but pretty close. And Zeke, Vildana brought up the regulatory environment, and one of the reasons why the regulatory environment is the way it is because of FTX and what we saw with Sam Bankman-Fried about a year ago. Talk to us about what allegations Sam Bankman-Fried is actually going on trial for tomorrow.
Yeah, it's kind of it's understandable the regulators are a bit nervous because the last guy who came in and was like, hey, look at my cool crypto thing. It's so great. They were like, yeah, we love it. And then it turned out to be a giant fraud.
Which is worse than a nothing burger, I think.
Yes, definitely. So the government has accused Sam of several counts of fraud. At the center of the case, when his crypto exchange blew up, FTX, there were $8 billion missing. And they're basically saying it boils down to he embezzled that money and gambled it away with his hedge fund, Alameda Research.
Did they ever find that $8 billion?
No, it's still gone.
So they haven't found that $8 billion, and we know this is a trial for SBF himself here. But when the collapse came, there were a lot of questions about the other crypto players as well, and I guess how on the up and up they were here. Why are we at this stage right now where he seems to be the only one right now embroiled in this, at least in terms of FTX, I should say, not just him?
Well, some of the other crypto founders have been careful to avoid U.S. territory and may have been avoiding a case that way. Then we've also got Celsius's Alex Mashinsky was arrested a few weeks ago and was charged with a big fraud. I mean, if it hadn't been for SBF, there might be some more heat on some of the others. Three Arrows Capital, one of the biggest
they caught
hedge
that guy
funds.
Finally, right? Where was he hiding out?
So he was just arrested in Singapore.
Okay.
I don't know what.
Didn't we know he was in Singapore?
Yes.
Yeah.
The case is a bit of a mystery.
Yeah. It's a bit of a mystery here. And Valdana, I want to bring you back into this conversation because as Zeke wrote this great book, Number Go Up, which I have to remember. Yeah, really good book. I have not read it yet, but don't worry, Zeke. I plan to eventually. And she's recommending it. But it gets to the whole idea of sort of what this whole crypto boom was, right? Because it was about, first it was about just, I guess, I don't know what, just speculation. Then it was about a store of value. Then it was about economic hedging. And then it was about I can transact and buy like a pizza with it for like $10,000. What is it now?
Yes, it's all of those things. It's always all of those things, which is what I love about the space because to any given day or to any given theme, you can sort of conform
it's
the
like,
idea.
It's like those like kind of pick your own adventure books.
A little bit, yes.
Yeah,
and I think during...
Except you go broke at the end or something.
It's possible. I mean, it's possible. But remember what was happening during the pandemic. Everybody was getting really rich, which is what Zeke's book touches on. And so that's why we had that boom where we had all of those retail investors coming in and spending their pandemic checks on whatever coins were available for trading back then. We've not had those retail investors. They've left the space.
Well, to that point, I mean, we were talking about the Bitcoin futures ETF launched 2 years ago. Bitcoin got close to $69,000, and we haven't seen anything close to those numbers since. Right now, we're below $28,000. So you think about some of the big narratives right now, the fact that maybe we'll finally see a spot Bitcoin ETF launch in the U.S., but a lot of those retail players have been flushed out. Volume, as you know very well, is not anything close to where we used to be.
That's exactly right. And so a lot of people are sort of hinging their hopes on a potential possible spot Bitcoin ETF that maybe potentially we might see sometime in the next couple of months or early next year. It's not a given. The SEC has not said either way that they're going to greenlight it. But you're right. The retail investor base really has left the crypto markets and not come back over the last couple of months and years.
Are you going to have a sequel to this book, Zeke?
I think we'll never see a mania like this again. I don't know what I'm going to write about next, but not crypto.
Well, it was nice knowing you. Had a great career so far.
Well, we're going to hold you to that. Guys, really enjoyed this conversation. Our thanks to Bloomberg's Valdana Heinrich and Zeke Fox. He is the author of Number Go Up.
What's the origin of that phrase, Katie Greifeld?
It's Twitter, right? Just Twitter. People saying
Bitcoin talk, number go up because number go up, and then it goes up some more.
Okay.
It worked well.
So it's exactly what it says.
Lasted, yeah.
just not grammatical.
Definitely recommend people read it. But coming up on the close, Kellogg splits into two separate companies. We'll look at the strategy behind the move in our Stock of the Hour.
Is there an audiobook for this yet? I like audiobooks.
Zeke's going to record it right after this.
Okay.
This is the close on Bloomberg.
Time now for our Stock of the Hour and a focus on Kellogg, or at least the company formerly known as Kellogg. The company planning to split into three and now taking place did in the first leg of that separation into here. Kellanova and WK Kellogg, two separate companies right now, beginning trading today. And well, you see the market reaction there, down 6 to 7% on the day. Dina Schenker joining us right now to help walk us through exactly what we've learned here. And Dina, just kind of start off with Kellanova, because this is basically the old Kellogg as we know it. Aside from the fact that it's kind of a weird name, what exactly are they selling? Are they the cereals business, the snacks business, the plant-based business? What?
So basically, Kellanova is everything Kellogg was except for the North American cereal business. So that means it is international cereal, it is snacks, it is frozen, plant-based, waffles. all the things you think about with Kellogg, except maybe the most iconic, which is their North American cereal business.
And then what is KLG, which is the other ticker, WK Kellogg? What are they doing?
That would be the cereal, the North American cereal business, which is really, I think, what everybody thinks of Kellogg as, and now it's something else.
And at some point, there's going to be another separation, right? Because there's going to be basically three pillars of independent companies here. When does that happen?
They are only splitting into two companies. There had been talk of selling off the plant-based part of the company, but they decided in the end to hold on to that business.
Okay, gotcha.
So Dina, reading through this story, I learned a lot about cereal this morning. And so they're separating the international cereal from the U.S. cereal. How do those two markets compare to each other?
Well, the North American cereal business has been declining for some time now, for years and years. There was a brief moment during the pandemic when everyone was locked at home that cereal sales came back a little bit, but once again, they are on a decline. There's been a lot of talk as cereal as a snack for as long as I've been covering it. And even though Americans love to snack and are snacking more than ever, cereal is not getting the benefit of that. Internationally, though, cereal is doing better, especially in developing markets. We're seeing Kellogg is selling a lot of cereal, but those parts of the business will stay with Kellanova, not with WK Kellogg.
And let's also talk about what we're seeing when it comes to some of these weight loss drugs, because you had a really interesting story out on the terminal from the CEO of Pringles, the CEO of the Pringles maker, rather, saying that the company is studying the threat from Ozempic. Is this something that basically every food business CEO should be thinking about, that Kellanova, the Kellogg CEOs, should be thinking about as well?
Oh, I am sure every food company CEO is thinking about these drugs because they suppress appetite. And right now, there's no noticeable shift in consumption that anyone has reported on, as far as we know. But this could be a major threat to the big packaged food makers, which have, made their businesses on selling large quantities of food because people will eat large quantities of food. So what happens when people are no longer eating as much? For now, though, that is still way in the future, as Steve Cahillane, the CEO of Kellanova, emphasized. But like you said, they are studying it. They do not plan to be complacent.
All right, Dina Schenker there. A look here at two new tickers, KLG, of course, and we talk about the old K, Kellanova, and WK Kellogg. This is the countdown to the close. Romaine Bostick here alongside Katie Greifeld. We talk about a market, Katie, I think that was looking for some sort of relief. They did get it over the weekend, of course, where the shutdown was averted, at least for 45 days here. But that doesn't really matter here. There's a much bigger story out there.
Much bigger story. And you think about, again, the fact that we could just be in this movie again in 45 days, counting down to the deadline as we were this weekend. Pretty short reprieve. Yeah,
a pretty short reprieve here. And maybe a big part of the reason is because you're seeing those yields continue to move higher here, up 11 basis points right now on that 10-year yield. And this has been a relentless. The sell-off that we've been seeing in treasuries, particularly even on the long end of the curve, that seems to suggest here that not everyone really is on board. You see that reflected in the utility index as a group down 5% on the day, banks as a group down 3% on the day, and oil stocks as a group down, Katie Greifeld, 4% here on the day.
Of course, you add that all together at the S&P 500 continuing to fall here. It feels like for so long, the market was able to brush off the threat of rising yields when you think about the promise of AI, but it seems like we're past that point now.
Yeah, let's get some insights out of our next guest. Barry Knapp joining us right now to help count us down to the close. He's a managing partner over at Ironsides Macroeconomics. And Barry, there's been so much discussion here about where we are in this economic cycle and what the market is trying to price in here. Where do you actually see us in that cycle right now?
Well, unlike a lot of economists, prognosticators, I actually think we had an income and earnings recession. Last week's GDP revisions did eliminate one of the negative quarters in gross domestic income, which tends to capture business cycles more quickly than gross domestic product does. But the corporate contribution to that, known as net operating surplus of private enterprises, That was negative for 3 quarters. So fourth quarter of last year, first quarter of this year, and second quarter of this year. It looks like we're trying to come out of the earnings recession. However, the Fed's overly hawkish position risks what I'm thinking could be a double dip recession. So broadly, the way I've characterized the economy is we're in what I think is an unstable equilibrium. And what I mean by that is the non-financial corporate sector has largely termed out its debt. It's reasonably immune to higher rates. The tech sector is a poster child for that. Then you have the household sector, which in aggregate is reasonably immune. We've all seen the charts of the effective mortgage rate at 3.6, even though new mortgage rates are more like 8. But then we have the deeply inverted yield curve, which has only been this inverted 3 times in our history, which is a huge existential threat to small banks, small businesses, commercial real estate, multifamily real estate in particular. And if the Fed is really intent on keeping the policy rate above 5%, the unstable equilibrium will become, a broader, unstable systemic event, and a big problem for the government as well, to be sure.
Yeah, I'm curious as to why we haven't heard, I guess, a little bit more dovishness out of the Fed. I understand that they want to sort of guide the market in a way that it makes it easier for them, but we're sort of at this inflection point with regards to the disinflation that we've seen in the official data, of course, the high baseline that we're seeing in Treasury rates right now, and the idea that, as you just pointed out, Barry, a big part of this economy has largely managed to weather that. So I guess the question really becomes is, why not just sort of stop now? Let's just stop and just see what happens.
That is an awesome question, because I've been asking the same thing for every rate hike since Silicon Valley Bank went under. I mean, my outlook for the year was that the path from 9 to 4 on CPI, and ultimately it was the 3, was very straightforward. There's 3 ways to disinvert the curve, and the curve, mind you, needs to be disinverted by the first part of next year. The best outcome and the benign outcome, and the one that you're describing that has been the story all the way up until August, was this, bull steepening driven by disinflation. And the inflation has fallen faster than the Fed thought. It's also not behaved the way Powell described it as likely to behave all the way back last November. So, yeah, I think you ask an excellent question. They should have paused. They should not have given off such a hawkish forecast. He's done that 3 times, or the committee's done that 3 times this cycle. A year ago, September, at the monetary policy report back in early March, that was quickly followed by 3 bank collapses, and then again this go around. And I just don't understand where they're coming from. I mean, they love forward guidance. They think they really have an impact on inflation. I totally disagree with that. But this last leg of the move in rates is all about overly hawkish Fed policy. It's supply driven at its core, but the Fed really blundered.
Well, when you say, okay, so it's supply-driven at its core, but it also has to do with the fact that you have this, in your words, overly hawkish Fed. Is that the market pricing in structurally higher long-term rates when you think about what's happening 10 years out, 30 years out?
I think that's exactly right, Katie. I was thinking, I've been thinking about this a lot recently, 39 years in the markets, and I really only remember 2 occasions where we had a really significant repricing to absorb supply. The first one was in the beginning of 2021, when the Republicans lost the Senate through the signing of the American Recovery Plan. That was $1.9 trillion of unexpected stimulus. And then again, after the August 2nd pre-announcement. And so, yeah, the back end's struggling with this. And when you look at the debt profile of the country and realize that if rates really are above 5% for 15, 18 months, that eventually the government is going to have to finance that with more borrowing, which is just that's what Reinhardt and Rogoff wrote about, and it's different this time. So, the market is definitely balking at the Fed's approach to this, no question.
And Barry, we only have about a minute or so left with you. And given the fact that the Fed is leaning hawkish, the fact that, in your words, they should have paused, obviously they haven't. When you deal with those facts on the ground, where are you positioning right now? How do you build a portfolio around that?
Yeah, I was in the camp all year long that we were going to retrace the entire move. We'd go to 4,800. After that Fed meeting, that's no longer my base case. Now, we could get a really weak payroll report on Friday, and maybe a deterioration in the growth outlook will lead to a Fed attitude adjustment. But right now, I'm pretty defensive. The problem, as you guys were noting, is the defensive sectors were prohibitively expensive. Utilities are getting absolutely shellacked today and last week. So there really was nowhere to hide other than to just raise some cash and wait for a better opportunity. But for me, the Fed pivot, maybe on a weak payroll report, would be one way out of this.
Yeah. All right, Barry, going to have to leave it there. Great to catch up with you. We haven't spoken in a while. Barry Knapp there over at Ironsides, helping us count you down to the close here. Katie Greifeld, just about 2.5 minutes until we get there. Stock still around session lows.
Around session lows on some pretty elevated volume. You take a look at the S&P 500 right now, volume about 14% elevated.
We are moving closer to those closing bells. Our full market coverage right here on Bloomberg begins soon as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Tim Stenovic and Carol Massar still here for 3.5 days this week. Welcome to our Bloomberg audiences across television, radio, as well as our partnership with YouTube. Carol Massar.
Today already feels like 3.5 days, but go ahead.
Well, yeah, I assume you're referring more to the market rather than to me, because we have a market that's causing a lot of concerns here. I mean, look, we talk about this rise in rates here, and it's been relentless. This sell-off that we've been seeing, pushing rates higher once again here, and that's having an outsized effect on equities as well. Yeah,
absolutely. You see it in the trade, and I feel like finally everybody's getting kind of into or understanding of this idea that it's going to be a higher rate environment, and where we ultimately top out, who knows, but it's going to stick around for some time. Having said that, one of the things that jumped out for me and very sensitive to the rate environment is home builders. They're down about 1%. Specifically, they'll want to call from UBS, which lowered price targets on several names, D.R. Horton, KB Home, Lennar. But I'm going to keep watching that home sector because I feel like very sensitive to what's going on. That group's up for the year, Tim, but nonetheless down about 1% today.
I'm trying to get as much commentary about the consumer and the strength of the consumer as I can. We're about to get into earnings season, so we're going to hear from the big banks soon, and we'll get some commentary about the consumer from them. But Romaine, the big take today, all about the U.S. recession being more likely than a soft landing. Mm-hmm. So we spoke to Anna Wong about that, and then we just spoke to Lisa Erickson over at U.S. Bank Wealth Management, who said the consumer is hanging in there. The consumer is hanging in there. So what's going on?
But hanging in there, I don't know. You want a strong consumer. You don't want one hanging by basically their fingertips off the cliff, which is what it sounds like. A lot of people think that where we're at right now. And I guess we're going to find out in a big way, Tim, over the next couple months here as we head into the U.S. holiday seasons. Let's walk you through some of the numbers here with the Dow Jones Industrial Average. Going to finish the day in the red, down about 0.2%. Meanwhile, the S&P 500, which was down more than 0.6% at one point, actually inching back into the green here at the close, only higher by less than 1 point here, but I guess some people will take that here. The NASDAQ Composite doing a little bit better, up about 0.7% here on the day. The NASDAQ 100 up 0.8%, but the big laggard on the day was the Russell 2000, which was right around down about 2%, and at its lowest point on the day. It's going to close here, Carol, down 1.6%.
Yeah, and down for the year. It's down about 0.25%. So very telling in terms of those domestic companies here in the United States.
And almost down 10% from that year-to-date high, too.
Yeah, significant, right? Yeah. And I think that we're getting a lot of market conversations around that trade in particular and what it forecasts. Katie, hey, the S&P 500, not as negative as it looked certainly earlier in the day, as Romaine pointed out, but still 391 names to the downside. Katie, 112 actually eking out some gains here.
Yeah, and you're taking a look at the industry groups here. There's definitely more red than green. If we think about what did well, though, media and entertainment stocks, so too some software and services, and some semi names as well. But then you go down towards the bottom, energy, banks, some of your biggest losers, and utilities. I want to meditate on utilities here because it's just an awful day. On an industry group level, utilities fell 4.7%. The sector alone fell 5.6% to its lowest level since June 2020. So quite a breakdown in utilities, Carol.
Yeah. And can I just real quickly just add transports to that? I know it's not an S&P sector, but I was just looking at that. If you go from the highs in July, we're now down more than 11% from those highs. So basically correction territory.
All right, guys, let's get to, I think that's really significant. I always love watching those names, right? There's companies that move stuff around and it's a great indication of what's going on in the economy. I do want to go to NVIDIA, if I may, because it's topping the S&P 500 today. At its highs up almost 4%, finishing the day, though, still with about a 3% gain. Goldman Sachs adding that name to its conviction list. The firm seeing strong long-term growth prospects for the chip maker, as we know, a major player when it comes to all things AI. There's more to it. Check out the Bloomberg and get a little bit more on what Goldman said, but nonetheless, a standout today. Also top in the S&P 500 today, Google, Alphabet specifically. Microsoft CEO Satya Nadella testifying today in the DOJ antitrust case against Google, saying that Google is likely to extend its dominance of the search market into a new generation of AI-powered tools, basically giving the edge when it comes to AI. It was very different from some of what maybe he said back in February when Microsoft beat Google with an AI-based
This trial is really like giving us a lot of gifts here, a lot of Easter eggs about kind of what these companies were doing and
what they really
their plans, what they were going to buy, what they weren't here. Yeah, quite interesting.
Yeah, but nonetheless, Google, though, then as a maybe potentially, right, can maybe draw a line there to what Satya Nadella said, giving a boost maybe to shares of Alphabet. And then Sphere Entertainment. I don't know if you guys have seen what they are doing in Vegas. It is unbelievable.
It looks so cool.
I want to go to this
Would you go to see U2, Katie?
Yes, absolutely. Are you kidding?
That's cool.
$1.4 billion market cap company, live entertainment media company. Sphere venue in Las Vegas opened on Friday with a show by U2 specifically. But the stock, quite a rally. It's up about 105% year to date, about 9% of the float shorted. But I do think about, right, when we go to see a concert, it's often in a sports stadium. This is a venue that was created specifically for performers.
Instead of a sports stadium, you could be inside of the shape. That sounds awesome.
It's a lot of video screens, almost as many as we have.
To be fair, I did have friends sending me videos from, like TikToks of the concerts. No, it was TikToks. Like they were going viral all weekend.
Unbelievable.
Yeah.
I watched them all. I loved it.
All right, let's get to some of the decliners here. Katie, you talked about utilities lagging. The worst performer on a points basis and a percentage basis was indeed a utility. Nextera Energy. Goldman Sachs cut its price target to $72 from $83. Fell today by close to 9%. Rivian also finishing it down lower. Shares falling after the company's full-year delivery outlook missed the average analyst estimate, down 2.55% on the day. This as third-quarter vehicle deliveries beat expectations. Should note shares were up 18% last week, so keep this in perspective. And then here's one for you, Kellanova. It's the company formerly known as Kellogg Company, or at least some of it. Yeah. It's completed its separation of its North American.
That just rolls off the tongue.
It does, yeah. Kellanova. It's
How much did they pay?
It's like cereal in space.
How much did they pay a marketing consultant?
Pringles, Cheez-Its, Pop-Tarts, Kellogg's Rice Krispie Treats, Morningstar Farms, Incognito. That's a good name. Okay. Incognito is a good name. Garden Burger, RX Bar, Eggo, and more. It's the first day, down 5%. WK Kellogg Company is now the other company from Kellogg. That fell today too.
Yeah, they're interesting moves here because I thought investors were sort of welcome to this, but I guess for today, I don't know, Tim.
Did Mondelez start this, Romaine?
I don't know. I mean, there's been a lot of discussion as to whether there was like more value to sort of have some of these consumer product companies sort of as standalones rather than that sort of conglomerate model here. And I don't know. It honestly was confusing. We were speaking with our Bloomberg reporter a little bit earlier, who was kind of talking about one is focused on the North American cereal business and the other on European. And then Katie asked a good question, like, is there a difference? I mean, I don't know.
I'm glad I wasn't the only one confused by it.
I don't know. Do they eat? I don't know.
International cereal versus North American
International cereal is doing better than North American cereal right now.
Is it porridge that they eat overseas?
I don't know. I don't think I want that. But apparently the rise of snacking in the U.S. Has sort of taken away from North American cereal. At least that's what I heard. So.
All right. Well, Carol Masser, of course, dunking on our European friends there. And
I love our European friends.
Well, let's talk about what's this real quickly in the yield space here. Yeah. I do want to go back to that here because it was a pretty strong move higher across the whole yield curve, particularly in the middle of the curve, 11 basis points higher on a 5-year. here, 12 basis points higher on the 10-year, and even your 20 and 30-year was up about 10 basis points or so here. And this has really become the story here because that had a big effect on the dollar, and that in turn had a big effect on what we saw on commodities, and obviously, of course, a big effect on what we had in the equity markets. And the big question now becomes what sort of arrests this sell-off that we've been seeing in treasuries. We heard from Powell earlier today. He didn't really have much to say, but we heard from Bowman and a few other members as well here, and the higher for longer mantra is still there.
And the flip side of that question, what arrests the sell-off, is also how high do we go? Because especially on the 10-year, we're looking at some pretty amazing levels, nearing in on 470. Of course, we're at 15-year highs or something. Do we get above 5%? It looks a lot closer than it did even just a month ago, even just a week ago.
Yeah, it is pretty. Wait,
well, I was going to say Katie Kaminsky's 6% that she talked to us a few months ago
Seems
about.
charming right now.
Yeah, it does seem charming. I mean, now, is it Jamie Dimon's 7% that we're headed to?
But this gets back to I don't know if it was Tim or Carol about the idea of the consumer hanging on to, but we forget, like, it's not just what people are paying, but also just the debt servicing costs that they have already. It's easy to talk about fixed rate mortgages, but you forget all the credit card balances out there that presumably are now being charged a much higher rate than what they would have been, I don't know, a year or two ago here. And there's a lot of other revolving credit as well as new forms of credit, such as buying cars and other things that people have to do, where it's just going to completely change the dynamics of what's left in your bank account after you pay that bill.
It's why we have to continue to keep watching consumer balance sheets, spending patterns, what's happening on, with credit card delinquencies. This really tells us the health or lack thereof of the consumer. So
yeah, there's only so many people that can fly to Vegas and sit inside a dome.
You weren't supposed to tell anybody.
Guest tickets are only like $120 too. They're pretty cheap.
Some people go to Beyonce, some go to the Sphere.
Some Sear and
Jim thinks that's cheap.
Peter.
All right.
Anyway,
we got to wrap.
High roller over there.
He is a high roller. All right, guys.
That $20 seats. Where are those?
They don't have those at the Sphere. Sorry.
All right, Monday's over. First quarter, second quarter, third quarter, fourth quarter are now underway. Certainly in the trading world. All right, guys, join us. What?
We are, Carol. It's fourth quarter. Thank you.
Thanks for the reminder. All right, we will be back again. Our cross-platform coverage, radio, TV, YouTube, and of course Bloomberg Originals. We'll see you again tomorrow.
We continue our coverage right here on Bloomberg Television. The close here and a look here at maybe potential entrance into the market. The IPO activity that we saw last month might actually see a little bit more juice this month. Birkenstock drawing some big name investors ahead of its IPO. We're going to get the latest. This is Bloomberg. $42.88 and change on the S&P 500 on the day. That's relatively unchanged, but it could have been a lot worse here. This index was down more than 6/7% at one point in the session, and it looked like it was heading lower. But instead of talking about the top, instead of talking about what the 12-month price target is going to be, maybe start to talk a little bit more about the floor. What's some of those technical levels at the bottom that are supporting this market and how well they've held up? They've held up pretty well here, and a big part of the reason is a lot of investors now are starting to pare back some of their short bets on the market. Now, that doesn't necessarily mean they're piling in and going long here, but the idea that the S&P may have fallen as far as they think it's going to fall, at least in this part of the cycle, that may be in the cards right now. You saw some of the optimism in the NASDAQ 100 on the day as most of the Magnificent Seven provided a bit of a lift, 0.8% higher on the NASDAQ 100, and that's despite the big uptick that we saw in yields, 11 to 12 basis points on the 10-year yield, and it was similar across most of the curve. Now, that didn't necessarily mean that this was some sort of broad-based rally that lifted us. In fact, it was just the opposite. Maybe a little bit of defensive positioning, but defensive to be sure. Tesla did get a bid here, up 0.5%, despite some of the concerns here about its latest delivery metrics. And believe it or not, a lot of the Bitcoin and crypto-related stocks rallied pretty hard on the day as well, including Marathon and Riot. Meanwhile, though, the elephant in the room isn't just what's going on with yields, it's what's going on with the dollar. And as people pair their short bets for the S&P 500 and the futures in that market, they are starting to extend their long bets on the dollar, something that we haven't seen in quite some time. You overlay that with some of the leverage positions in the Treasury space and the idea that they expect that sell-off to continue here, and you think you have a good sense here as to why this market could end up being range-bound, at least based on some of the positioning that we're seeing out of that CFTC data. Katie?
Well, let's go from the currency market to the IPO market because Birkenstock is just the latest company testing the demand for new listings. The 249-year-old German footwear maker and its private equity owner are seeking as much as $1.6 billion from an IPO. It's attracting interest from the likes of the Norwegian Sovereign Fund and the LVMH chairman. Joining us now for more is Bloomberg IPO reporter Ryan Gould. And Ryan, what do we know so far? What's the next step in this process?
Well, Katie, I would say at the outset that the company defied what we thought could have been a looming government shutdown. Let's see how that goes in about a month's time. But they got out after a frenzy on Friday with some scrambling back and forth to put the registration statement before the SEC. Luckily, they didn't have to sort of, get out on Friday and get things working today. They're out this morning setting off on its roadshow. They're looking to market as much as for $1.6 billion. Birkenstock itself is selling 10.7 million shares, and El Capitan, its owner, is selling 21.5 million. As you mentioned at the top, I think this one is very much in trend with what we've seen in the past couple of weeks. It's got the Norwegian Sovereign Fund there as an anchor investor. It's also got LVMH. It's got Henry Ellerbogen's fund, Durable Capital, there as well. And these anchor orders are pretty much very on trend. It's front cover. It's telling investors that these are good offerings, and you will have to compete with us to get some allocation.
There has been some concern coming out of the last big spate of offerings that we had, including ARM, Instacart, and a couple others that I'm forgetting, Klaviyo and a few others here. And the idea that that the secondary market trading wasn't necessarily as favorable as some people thought, and whether that would put a damper on other companies coming into market. Is that not having an effect?
Not too much, and I would say it's probably worth drawing a bit of a cautionary line, because Birkenstock is really the first retail, pure retail company that we've kind of seen go public probably since Allbirds and On Running in late September 2021. We haven't had so much of a retail offering put before investors. I think what will be interesting to see is how they do price this one. On a fully diluted basis, they're targeting 10.1 billion valuation. But
have you heard anything in your reporting with regards to just the potential appetite from the retail side? The idea that you mentioned this being a retail company, it's a brand that everyone knows, unlike maybe some of the other companies that went public. I mean, if ARM, most big investors know ARM, but if you went out onto 59th and Lexington and just asked a random person, they probably wouldn't know what you were talking about. Everyone knows Birkenstock's here.
I mean, people really want to get a handle on, what the latest is. I mean, I've heard from sources.
Do you own Birkenstocks?
I have owned one pair. I can't say they're necessarily worn every day, but they are in the closet.
Like mine,
I think, one thing I would say, just to sort of draw it to a whole circle, I guess, is that this is still quite cautious. We've seen some people, push back on the idea that they want to get out in the fourth quarter. The first quarter still looks a little bit touch and go for next year. If you have a premium asset, the message seems to be from sources that I'm speaking to, you can go out at any time. But if you aren't really holding on to a quote-unquote trophy asset, then you should probably be treading cautiously.
I think that's a really interesting point, because when we were talking about ARM, for example, the narrative was very much this is going to open the floodgates, that basically everyone who's waiting in the pipeline might be more willing to come out of that pipeline. But you consider the environment, the stock market, and sort of risk appetite right now, it feels like things are still very tenuous.
Very. I think what's interesting is that Klaviyo has actually been the best performer of the sort of three major IPOs we've had in the past month. Klaviyo is the first enterprise technology software company to go public in 2 years, pretty much, give or take. And ARM had all this fanfare. It will still continue to be a name that people want to get their hands on, depending on what, regardless as to what happens where the share price goes. But, I think it's interesting that there's quite a bit of structure amongst these deals. If you look at Instacart, there's probably still quite a bit more supply to come, so it'll be interesting to see where the trading goes over the next couple of weeks. And of course, most investors in these names are looking ahead to the first set of results. Once they report, they want to see, how they've done in their first quarter as a public company, and that should give a better barometer as to, longer term.
And well, to that point that things are still fraught, there's still a lot of nervousness out there. Looking at your reporting, according to people with knowledge of the matter, maybe we start to see Birkenstock trading on October 11th. But is there any chance that this gets delayed, that this gets pushed out?
Per sources, Katie, all I can say is right now they are very much looking ahead to next week, pricing a week tomorrow. So on Tuesday next week, they'll look to price. I will say that obviously, I think there's a German holiday this week, and next Monday here in the United States is Columbus Day. So we've kind of got a book building period right now, a roadshow, which has been kind of bookended by 2 holidays. Based on what I'm understanding, I don't think that's going to affect much.
All right, Ryan, great stuff. Do you own Birkenstocks, Katie Greifeld?
I do.
Okay, I figured you did.
Yeah.
What color?
Pink ones.
Okay, I didn't know they made
My
pink
mom
ones.
got them.
I guess, well, thank you to your mom. Ryan, great stuff here. We're going to be keeping an eye, of course, on that potential IPO here. And, you know, headlines crossing the wire right now, Katie Greifeld. Did you know that Chiefs-Jets game on NBC last night was the most watched Sunday game on NBC going back to February?
I guess when you tease Taylor Swift is going to be at this specific game for a week straight, that's what happens.
I think every NFL owner right now has Taylor Swift, trying to kind of call Taylor Swift's people and say, will you please
We've
come
got
to
a
our
really
game?
cute quarterback. Maybe we can introduce him.
The Taylor Swift effect on the NFL coming up here on the big program. We're going to talk about the real estate market. There's a new MLive Pulse survey out on the outlook for offices and commercial real estate, and the results are kind of interesting. That conversation coming up next. This is Bloomberg. A focus on office prices right now in the U.S., which actually may be due for a crash. And the commercial real estate market faces at least another 9 months of decline. That's at least according to what we heard out of our latest MLive Pulse survey. Bloomberg reporter Scott Carpenter joining us right now to talk a little bit more about the results. And let's start off with the big headline result, which is that about 2/3 of the respondents to this survey basically said that we're not going to get a rebound in the commercial real estate market, the office market, until we get that crash, which apparently hasn't come.
That's right. I think a lot of people would be surprised by this. People think there is going to be a crash. A crash is a serious thing. You talk to people who are in the sophisticated real estate analysts, and they'll say that, you know, this isn't something that's coming out of the blue. We've seen this for a while. But that's right. It's 2/3 of analysts, and these are people polled on Bloomberg.com and on the terminal, mainly on the terminal, I believe, that think there's going to be a crash before there's a rebound.
The question I have, though, is why we didn't see that crash. Is the idea here that basically the folks who are most exposed to the risk in this space right now are still holding their assets rather than actually liquidating them or being forced to sell them?
That's right. Office leases last a long time. And right now, nobody wants to sell. There's very little of what people call price discovery. Everybody is terrified of selling at a very, drastically lower prices, and then the next month somebody else does another deal and they get way better value. You don't want to sell without knowing what a price is, and nobody knows what the price is.
So we're talking about a crash. Does a crash necessarily imply systemic risk, or are we not there yet?
Nobody really knows for sure, but I talked to 2 different real estate experts for this story, and one of them was saying, no, I don't think this is systemic risk. And the reason is, and the other one mostly agreed, and the reason is because banks own around half of all commercial real estate. They generally do fairly conservative underwriting, and it's spread across a large number of banks. So first of all, I think a lot of these globally systemic investment banks have, and they're fine, so that's not a risk. Regional banks own a large portion of commercial real estate as well, and they're stepping back, but I think for the most part, experts aren't too worried about either of those.
And it feels like for much of 2023, regional banks' pain has somehow been private credit's gain. Is that the same sort of dynamic that we're potentially looking at here?
I think that's right. Because regional banks, everybody's worried about them. They're stepping back. The question is, when commercial real estate debt comes due, who is going to step up and refinance it? Regional banks stepping back, who's going to step in? And the answer in many cases is private lenders. We've done some reporting on that. They're raising money, preparing to step up to take on some of this real estate debt when it comes due. There's $1.5 trillion of commercial real estate debt coming due by I think 2025. Somebody's got to refinance it. And regional banks own a lot of it right now, but they're stepping back.
I am curious about some of these big asset managers and some of these big funds that we know are holding a lot of this stuff. And we spoke a lot earlier this year about some of the redemptions, or at least the redemption requests that we were seeing into some of the main Blackstone funds, the B-REIT funds here. And then the latest story basically being that some of those redemptions, that growth has slowed, but that still doesn't address the issue of sort of what's actually in these portfolios.
That's right. I think what it shows is that people recognize that real estate is not the greatest place to be right now. So we've seen more of those withdrawals. But at the same time, the withdrawal slowed. You know, that's good for B-REIT. And so there may be some recognition that this is a long-term trend here. They're not as eager as they might be to just demand their money right away.
All right, Scott Carpenter, a Bloomberg reporter here with the latest MLive Pulse survey. Really encourage everyone to check it out. Some interesting responses here out of the folks surveyed about the health of the office and commercial property market and why the bottom may not have occurred. Coming up here, we're going to go out to Washington and check in on, well, the shutdown that was averted, but still a lot of concerns about what happens in 45 days when they have to finally address longer-term spending measures and, of course, the future of the Speaker of House, Kevin McCarthy. A conversation coming up with Andy Blocker, Global Head of Public Policy over at Invesco. This is Bloomberg. An interesting day here in the market. Scott Soshnick, of course, helped to coin the term the Magnificent Seven, and I guess they earned that moniker today because without those Magnificent Seven stocks, it would have been an awful day. We were a little change on the S&P 500. The NASDAQ did manage to rally by about 0.8%, but the big sell-off that we saw in the Russell 2000, I think, was more indicative of where investor sentiment is at. Only 110 stocks in the S&P 500 managed to move higher here on the day, and if you factor out those Magnificent Seven stocks here, it would have been deep into the red. A big part of that reason was the resumption of the sell-off in the Treasury space, the entire curve shifting higher by roughly about 9 to 12 basis points, depending on what part you're on. That is a big part of the story, along with the resumed uptrend that we've been continuing to see in the dollar. 1274 in the Bloomberg Dollar Spot Index now starting to test some of those key technical levels to the upside. The VIX was elevated here on the day, and you actually saw an interesting activity in the commodity space, a sell-off in oil and a sell-off in some of the industrial commodities, giving maybe a little bit more credence to the idea that some investors are starting to sour on economic conditions, at least globally here, that may not be the support, Katie Greifeld, that some people thought we would have heading into the fourth quarter.
Well, Romaine, I do have a little bit of good news, and that is that the government is still open. It's still functioning, and that's because this weekend, Congress narrowly avoided a government shutdown and will be funded at least until November 17th. But Kevin McCarthy faces a possible motion to oust him as House Speaker. Let's bring in Bloomberg Balance of Power co-anchor Anne-Marie Hordern for more. And let's start with the fact that, again, the government is still up and running right now. Walk us through what came together before midnight on Saturday to get us through that deadline.
Well, it was really an 11th hour deal that came together over the weekend, and this is with Speaker McCarthy putting on the floor a clean continuing resolution, a stopgap funding measure to make sure the U.S. would still be funded after September 30th. This basically just meant federal government spending levels remain the same until November 17th. It also included $16 billion for disaster relief, which is really critical for places like Florida, New York, Hawaii. It did not include Ukraine funding, which President Biden is now saying he expects Speaker McCarthy to do the right thing on. He also, President Biden, according to our reporting, is going to call allies and reassure them that they think Ukraine funding will get there. But Speaker McCarthy said yesterday on CBS News that the border is priority. So he seemed seemingly linked Ukraine funding to border funding as well. And the second big thing to watch, of course, is yes, the government remained open, but it doesn't mean this is not without a fresh new headache. And that could be that within the next 24 to 48 to 72 hours, we could see a motion to vacate, a fancy term here in Congress for basically one individual, likely Florida Congressman Matt Gaetz, wanting to oust Speaker McCarthy. But remains to be seen if he has the votes.
This would be an unusual measure, of course, a measure that really hasn't been used successfully in more than a century. I am curious here. Gaetz said what he said here, but we heard a little bit earlier from some other Republican representatives, including Donalds and Roy, who were speaking on another network here, basically saying that they actually don't think that's the right move. Does Gaetz even have the support to actually move forward with this?
It's a great question. I mean, he just needs a small amount of support at the moment if he was going to have Democrats as well supported. But the other key issue is Catherine Clark, the Democratic whip here in Congress under Hakeem Jeffries, put out a letter to colleagues, first reported by Punchbowl News, reviewed by Bloomberg Government, that basically said we're going to discuss this in our conference tomorrow morning. So you could have a motion to vacate, but Speaker McCarthy maintain his leadership position if Democrats decide to vote present or not show up at all, which makes it much easier margins for him to clear.
All right, Anne-Marie Hordern, thank you so much. And of course, you can catch Anne-Marie and Joe Matthew back at 5 p.m. for their special editions of Balance of Power from Capitol Hill, featuring House Judiciary Committee Chair Jim Jordan and Colorado Senator Michael Bennet. But let's keep this conversation going now with Invesco Global Head of Public Policy and Head of U.S. Government Affairs, Andy Blocker. And Andy, it's great to have you with us on this Monday where the government is still functioning, but then you take a look at some of the issues that Anne-Marie ran through when it comes to Ukraine funding, when it comes to border security. Are we just going to be up against this same deadline in about 43, 44 days from now?
Well, Katie, that's probably what we're looking at. About 45 days from now, November 17th, we'll be right back where we were, except we may have taken one issue off the table. One of the issues that's been on the table from the very beginning is Speaker McCarthy and his speakership. He's basically saying, I'm calling your bluff. You've been continuously threatening my speakership unless I do everything you want me to do. I'm doing what's right for the country. I'm going to keep our government open while we debate these intramural politics. And so you'll see this week, either you'll see Matt Gaetz and others have the motion to vacate the chair or not. And if they have the motion to vacate the chair, they're going to have to play that out.
I am curious, and I don't want to get too deep into speculation, but there's this idea here that if McCarthy was able to cut the budget deal with the Democrats, at least the temporary deal here, that is there something to be extrapolated about whether the Democrats would be willing, at least at the bare minimum, to provide some degree of support should a motion to vacate vote actually hit the floor?
Well, that's, I think, the reason that Matt Gaetz and others did not call the motion to vacate back in May when they did the deal on the debt ceiling. They weren't sure what the Democrats were going to do. And I think right now, Matt Gaetz and others, they want to know what the Democrats are going to do because they don't want to go out there, do a motion to vacate, and that plan be subverted by Democrats either voting present, as Anne-Marie, your reporter, said, or by voting with McCarthy. They're more likely to vote present than vote for McCarthy.
This gets to a broader question, though, as well, Andy, about the leadership right now of the Republican Party, at least in the House of Representatives. And it's easy to say, OK, we don't want this guy, we don't want McCarthy, but always the question is going to be, who would you replace him with? And would he be able to, I guess, guide his party and give them what they want any better than what McCarthy has done?
Well, Romaine, I think you make a great point. You can't replace something with nothing. And as long as there's not a viable alternative to McCarthy, there's nothing really to talk about here. But if they were to do it, I don't see anyone actually raising their hand, volunteering, or even being drafted for this job unless some of the rules are changed so they don't come in and have one member have the ability to have a motion to vacate the chair. They don't want to have that. There'd have to be some rule changes and there have to be some agreement that, hey, if I'm going to take this job, you're going to support me and not support chaos.
And of course, Andy, as Romaine said, don't want to get too deep into speculation here, but you know, as you lay out in your notes that McCarthy had a choice, either preserve the speakership or avoid a shutdown. When we come up against that November 17th deadline, do you think that he'll make the same choice that he did this past weekend?
Well, I think he probably would, because if he's still speaker by November 17th, he will have won by calling their bluff. Either they have not made a motion to vacate the chair, or they've done it and they've lost. So why wouldn't he continue along this path? I think this is a very important point, not just for the House Republican Conference, but for our country. We can't be in a situation where a very, very small minority is able to dictate what the super majority wants. And as you saw the vote, it was like 335 to 91. That's overwhelmingly, people want to keep the government open while we debate these issues.
And Andy, a year from now, when we'll be speaking with you, of course, we're going to be knee-deep in the presidential election, that campaigning season for 2024. When you think about some of the issues at hand right now, the potential government shutdown, how is that playing into the 2024 campaign? How are some of the different candidates using this moment?
Well, first, I think President Trump is definitely using it to stir up as much chaos as possible. He's saying, hey, go ahead and shut the government down. Don't give in until they give you everything you want. So he wants as much chaos, as much disruption as possible to say, hey, look, President Biden's not leading the country. Look at the chaos you have. You want me back. That's going to be his message. As far as other candidates, well, in 2024, look, we're going to be doing this October 1, September 30th of 2024, a month out from the presidential election. So we're going to be right back here. That's going to have much higher stakes for how people view President Biden's stewardship.
Well, that gets us to a question, though, Andy, as to how much the American public, I guess, is in tune to what's going on with regards to these budget battles. Because there was all this talk as we were hitting this deadline, who would get the blame here? And I just wonder, like, do average people, I mean, do they really follow this kind of stuff? Do they understand it?
Well, they don't follow it day to day because they're busy doing their jobs, taking care of their children, taking care of responsibilities. But when they do see a soundbite or something they'll see a little bit. And the last couple shutdowns have been, I think, around 53% blaming Republicans and 30-something% blaming Democrats, but most people blaming both parties. So this is not good for anyone. So if people are trying to get political gain out of shutting down the government, or by trying to get their whatever they're trying to get out of the process, it really doesn't help anyone in power, and it only lessens the trust of the American people and the ability of its lawmakers to govern.
Yeah, well said. Andy, always great to talk to you. Andy Blocker there. He's Invesco Global Head of Public Policy and Head of U.S. Government Affairs. A look at the potential chaos in Washington, the chaos averted for now, and, of course, the chaos that'll have to be sorted out in less than 45 days. Coming up here on the big program, Jamie Dimon over at J.P. Morgan says that he's prepared for a higher interest rate environment. It's part of our exclusive interview with him. We're going to hear from that up next. This is Bloomberg.
Be prepared for higher rates. That's the message from J.P. Morgan Chair and CEO Jamie Dimon. He spoke with Bloomberg's Emily Chang on the sidelines of the J.P. Morgan Techstars Leadership Forum in London about the risks ahead.
The U.S. has been very strong for a while. No surprise, $5 trillion was pumped in fiscally, $3 trillion to $4 trillion of QE, and now that's being reversed. The consumer's still in good shape. They're still spending money. They still have more money than pre-COVID. It's spending down. Home prices have gone up for 15 years. Asset prices have gone up for 15 years. They're in pretty good shape. And then the people are talking about deterioration. Credit is not deteriorating. Credit card all-time highs, not inflation adjusted or GDP adjusted or income adjusted. And yeah, it's deteriorating. We think it's normalizing. And corporate credit's been quite good. So you have a strong economy. That's the here and now. All the data is a little distorted because of COVID and things like that. When you ask the question about a forecast, and I don't make forecasts, I look out there and say, what are the range of outcomes?
From hurricane to storm clouds.
No, I would put it as several storm clouds. When I said hurricane, I was correcting. Someone said the storm clouds dissipate. I said, no, that one may be a hurricane. We don't know what it is. Here's what they are. There are two of them that are different than other things. So we always have, I don't worry about the weather, and honestly, I don't spend a lot of time guessing about the economy. I mean, that to me is the sunny or rainy. I don't worry about that. We run the company to serve clients through thick and thin. That's what we do, to serve governments, to satisfy our regulators, and that's all weather. But there are two things which are extraordinary today, which may have different outcomes, and think of them as storm clouds. We don't know if they're going to hit, when they're going to hit, what they're going to do. Okay, so I'm not predicting that, but I'll tell you what I worry about. So one is the fiscal money being spent is so big, largest in peacetime ever, America and kind of around the world, with already very high deficits. And QT we've never had. So I know some people think QT will be uneventful. I'm not so sure. At a minimum, I expect volatile markets, and then you've got, and then all the long-term fiscal things are kind of inflationary. You know, oil prices, certain commodity prices, the green economy, you know, the restructuring of trade, you name it, I see it's adding to inflation, not subtracting inflation. So I don't think inflationary will be that, you know, keep on coming down. It may not. And therefore, rates may go higher. But the biggest storm cloud is geopolitical. It's Ukraine, the humanitarian crisis. You know, it's a war not far from here. It's along 600 miles, 500,000 people have been killed. It's nuclear blackmail. It's going to affect all global relationships in America and China, trade alliances. We don't know how it's going to start either. So I just put those two things as I keep a close eye on. And then how it affects the economy is different. And what I've been talking about that is, I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And,
well,
and how does
I don't know.
that
When I said 5%,
growth?
they said, are we going there? Yeah, it's possible. You know, so when I talk to my board, I say, yeah, can it go to 7%? The answer is yes. Are there factors that would drive it, you know, higher than, you know, where it is today? You know, 4.5, 4.6, or 4.7, over the 10-year bond now. Yes. Is supply and demand could push it high? Yes. I'm just saying, be prepared for it.
So,
and then the worst case is stagflation. You know, higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
What are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, you know, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too.
Where's China on the list of risks?
Oh, when I say geopolitical, that's the big one. It's the thread from Ukraine, oil and gas, food, migration, all our relationships, the most important one being China. That is the most important for the future of the world. And obviously Ukraine is affecting it. And in fact, it's very hard to see really positive outcomes with China until the Ukraine war is resolved. Hopefully, where the Ukrainians could say they have a victory of some sort.
A wide-ranging interview there with JP Morgan Chairman and CEO Jamie Dimon here talking about economic conditions and I guess the idea that JP Morgan can weather it all. What else would he say? But for those of us who don't work for JP Morgan, we do have some concerns about economic conditions. Bloomberg Economics actually saying that when everyone expects a soft landing, you better brace for an impact. The report points to several risks on the horizon, from strikes to higher rates to oil prices. Anna Wong joining us right now, the chief U.S. economist over at Bloomberg Economics. And let's talk about some of those risks, Anna, here, because, you know, we're so sort of inured right now to this idea of a soft landing, the idea that the worst may be behind us. But your models that you and your team have done seem to suggest that the worst might actually be ahead of us.
Yeah, because we looked back at 50 years of recession history, and strangely, we find that the peak of soft landing calls tends to appear right before a recession. And this happened in 2007, it happened in 2000, it happened in 1990, it happened in 2019 even. So I think the one reason why the soft landing course tends to peak right before a recession is that the lags of the Fed's monetary policy actually varies between different economic variables. So we are seeing some pickup in manufacturing. We saw from the PMI data today that things seems to be slightly better. And the housing market is also reaccelerating somewhat. But the places with longest lag is actually labor market and also credit conditions.
And when we think about that, I mean, that's what we've really been waiting for, any signs of stress in the labor market, and we really haven't seen it yet. But to your point, it seems like it's coming.
Well, I think the top two killer of economic expansion is, aside from the Fed, is also adverse supply shocks. So Jamie Dimon just talked about all these shocks, right? And they're all adverse supply shocks. So oil price increase, UAW strikes, which could lead to an increase in car prices again. So just the UAW strikes alone, if it becomes a full strike of 150,000 UAW workers, that could lead to 700,000 100,000 layoffs, according to our calculations. The unemployment rate could jump suddenly and non-linearly. And when you have this confluence of immediate shocks, it could just be the thing that jumpstart this non-linear dynamics of recession, which, to be honest, I think most economists don't have a good understanding of.
And where does Bloomberg Economics fall on the idea of a rolling recession? That maybe we don't see the entire economy turn down at once, but different sectors, different industries experience a downturn at different parts of time.
I think rolling recession is just another name for Milton Friedman's long and variable lags. It's the variable lags, but variable lags within the same economic cycle.
I have a question, though, about that, because I always hear this quoted, Milton Friedman's famous quote here.
Yeah.
Have things changed, though, with the Fed and the way it communicates, where maybe those lags aren't going to be as pronounced as they were when, I think he made that comment, in the 50s or something, when it was a lot different back then. You had no idea what the Fed was doing back then, and now Jay Powell comes out and tells you, or at least he tells you the version of events he wants you to know.
Absolutely. And so the Milton Friedman's quote is long and variable lags, and there are certain things whose lags are becoming shorter, such as financial conditions, because the Fed is so good at communication, the stock market immediately reacts. But what I'm saying is that their credit conditions and labor markets lags remain to be as long, 18 to 24 months for the labor market. And credit conditions lag are very long in this cycle because of all these pandemic policy that basically supported the balance sheets of many households.
Is there any sort of option, though, for the Fed to sort of, I guess, blunt the impact of those lags? I mean, how attuned are they to, I guess, what's lagging, what the potential effect would be, so they can calibrate their messaging and ultimately their rate decision?
Yeah, I mean, the Fed has some of the smartest people working.
I would hope so.
Yes, for sure. And I'm sure if they use these state-of-the-art academic models, they will be able to identify where the lags are longest and where the lags are very short. And I already, from the speeches of Federal Reserve officials, you hear that they still believe that the brunt of the lags still is yet to come. You heard it from Powell. We heard it from Michael Barr today at a luncheon. And so I think they do see what I'm seeing, which is there is still some substantial lags coming through in the pipeline.
They see what you're pretty smart too. They haven't invited you to show up there and give them a little bit of a lesson.
I used to work at the Fed.
I know.
All right.
Anna Wong, the best of Bloomberg Economics here, the chief U.S. economist there. A closer look here at the potential for a soft landing and maybe the potential for something completely different. Stick with us here on the big program. We're going to set you up for what markets will have their eye on Tuesday. This is Bloomberg. A busy start to the week for financial markets, potentially getting busier on Tuesday. Here in the U.S., we're going to get some labor market data, this on job openings.
Yeah, going to be interesting to parse through that JOLTS data. Of course, that's sort of the preview, if you will, to what we're going to get on Friday, non-farm payrolls, but I won't get too ahead of myself.
Yeah, don't get too ahead of yourself, but the government's open, so we know we're actually going to get it this time.
Yeah.
There was a little bit of concern. Tomorrow, actually, we're going to be out at the Greenwich Economic Forum. We're going to have a sit-down interview with Ray Dalio, of course, the founder of Bridgewater.
And I'm sure we'll hear him talk about interest rates, the Fed, the global economy, and who knows what else. Should be pretty fun.
Meanwhile, back here in New York City, we're actually going to have the start of the Sam Bankman-Fried FTX trial.
Just about a year after that alleged fraud was unraveled, I don't know. Do you think about where the crypto industry has been to over the past year and the price of Bitcoin? It's been pretty amazing to watch.
It's going to be an interesting trial, and I think we're all going to be wrapped by some of the testimony should it actually get to that. Auto sales numbers also scheduled to come out here for all the big automakers. We got a preview with those Tesla deliveries. Not quite that good.
Not too pretty. And of course, Kevin McCarthy watched all-day event. We'll see if his speakership is actually vulnerable here.
Yeah, of course, a lot of his Republican members are threatening to try to oust him. We'll see if they do that. Balance of Power is going to have much more coverage of that coming up right now. Meanwhile, Katie and I will be back tomorrow. This is Bloomberg.